بسم الله الرحمن الرحيم الحمد لله رب العالمين والصلاة والسلام على أشرف الأنبياء والمرسلين نبينا محمد وعلى آله وصحبه أجمعين رب اشرح لي صدري ويسر لي أمري واحلل عقدة من لساني يفقهوا قولي. Distinguished guests, industry colleagues, my friends, Assalamu alaikum wa rahmatullahi wa barakatuhu, and a very good morning, good afternoon to all of you joining us from different parts of the world. On behalf of Accounting and Auditing Organization for Islamic Financial Institution and its partners, Bahrain Association of Banks and Central Bank of Bahrain, for this particular public hearing, we welcome you to this first public hearing for the year 2021. This public hearing is on the financial accounting standards. And before we start the proceedings of the day, let me give you a bit of an introduction of AAOIFI. I'm sure all of us know of AAOIFI and hence we are here, but it's always important for us to remind ourselves on why, first of all, we are here today, and then why this institution as AAOIFI exists and the work it has been doing for the last 3 decades. So AAOIFI, as the name stands, Accounting and Auditing Organization for Islamic Financial Institutions, started as a not-for-profit organization in 1991 by 6 industry stakeholders. These stakeholders, whom we call our members, has grown since 240 members as we speak. Now, AOFI develops standards in 5 areas. These are Sharia, accounting, auditing, governance, and ethics. And these standards are developed with the help of 3 technical boards: the Sharia board, the accounting board, the governance and ethics board. And these boards have professionals and scholars from different parts of the world. To date, these boards have issued there are more than 116 standards and technical pronouncements in issue as we speak in these 5 areas. These standards have been adopted fully or partially, as well as used as guidance in more than 40 jurisdictions globally. In addition to the standard development process, AOFI helps in the implementation of its standards through its capacity building programs, through its fellowship programs, the CEPA and the CSAA, as well as it organizes and conducts advocacy and awareness programs such as the one we are having today, as well as other international conferences and events and workshops. Additionally, AOFI develops a technical bulletin called JOIFA. Now, as I said, AOFI develops standards in 5 areas. In general, what we say is that AOFI exists to secure the integrity of Islamic finance, and we do this by offering uniform standards in 5 areas of standard development. These 5 areas are not unrelated. These are interrelated areas, and a regulator can adopt them all as important pieces of the value chain and the ecosystem. So if I can state, AOFI develops standards in Sharia, which helps you differentiate between what is permissible and what is impermissible. It provides you core Sharia principles and rules applicable to Islamic financial transactions. When it comes to accounting standards, they help us present, record, and report the Sharia-compliant transactions in the right manner that represent the right characteristics as reflected in the statements. The governance statements exist, or they put in place systems and infrastructure that aims to strengthen public confidence and integrity in general. So it puts in place the systems, the infrastructure to ensure that the Sharia principles and rules can be implemented. The auditing standards are a very important piece of the piece. They exist to ensure that the Sharia principles and rules, as well as the implementation of the recording and reporting, is appropriate. The ethics standard exists to remind us, it's a continuous reminder to all of us how to conduct ourselves as well as our business affairs in the best of manners, which are in line with the Sharia principles and rules. Now, as I said, AOFI standards AOFI has been issuing these standards since 1991, and these standards have been adopted, adapted, or used as guidance in more than 42 jurisdictions. Now, some jurisdictions adopt them fully as they are, jurisdictions like Bahrain, so it has already become part of the law. So AOFI standards are fully adopted in a country like Bahrain. There are other countries and jurisdictions where AOFI standards are adopted partially. For example, in Pakistan, where some standards are adopted partially on a select basis. Countries like Oman, where our accounting and auditing standards are mandatory. So countries like UAE, where our Sharia standards are enforced. So as such, there are more than 46 jurisdictions globally where AOFI has a footprint in terms of its adoption, fully or partially, as well as they are used as a guidance to develop the local standards. So that's where we are. So we say that AOFI standards are adapted in different parts of the world in more than 30 countries and more than 42 jurisdictions globally. Now, as part of the standard development process, this is a very simplified version, and I'll just highlight why we are gathering here today. The standard development process is a very comprehensive process. It goes through different levels and there are different process that goes in reaching us where we are today. For example, the standard development process starts with identification of a project by the secretariat or the technical board, followed by a working group which is formed, and then a preliminary study is prepared as an introductory study for the preparation of a standard, and then a potential draft is developed for us to reach an exposure draft. The exposure draft is presented only after an approval of the technical board as well as the working group, and at times the approval of the Sharia committee. Now, once this exposure draft is presented, the exposure draft is put together. It is presented to the public in a gathering like today we are, for your expert feedback and comments on the exposure draft. Once these comments are received and these are presented to the working group as well as the technical board for their incorporation to ensure that the final standard is comprehensive from all angles. So the one highlighted here is the public hearing, for what we need, what we are here for. And it's a very important gathering for us as part of a standard development process. Now, let me highlight again the purpose of today. Of course, it's an opportunity for both AOFI to present its exposure draft and for the industry stakeholders to offer their comment and feedback. Now, AOFI's role here is more simpler and easier, if I can say that. It's basically to explain and elaborate on the core content of the standard, assist in its understanding, and answer any questions that you may have. This is our job as we are here. Your role as an attendee, and this is, and I'll reinstate that, I mean, it's a very important gathering. Your role as an attendee is to provide your comments, your opinions, your recommendations, your views and suggestions on this exposure draft. This can be in terms of highlighting any missing, if you are missing anything completely, you may think that we are not covering them at all, or you may think we are not covering them adequately, or you may think that we are putting something that is wrong. At times we can put something that is factually incorrect. You may also have a suggestion that a better wording can be used to explain certain points. And at best, you can also highlight the grammatical errors. The point is that we are here to listen to you, your expert advice, and benefit from it to ensure that the final document that we put together that will be used as a base document for the Islamic finance industry globally is comprehensive, is complete, is error-free, to say the least. And of course, the more feedback that we receive, the better it gets for the standard itself that we're putting together. So the idea here is not to have a one-way conversation, rather let's have an interactive discussion and benefit, and generally, have an interactive discussion for the benefit of the industry. So in case, some of us may not have gone through the standard as we speak, you can still share your feedback by sending us an email after this public hearing. It can be sent for financial accounting standards related email can be sent to accounting@aofi.com as highlighted on the screen. Now, before we begin, and of course there will be more, this is the first public hearing on the topic on financial account on this particular standard, FAS 1. There will be more public hearing organized on the topic to ensure that different people can join from different parts of the world. And in case you are not able to join today fully, you're more than welcome to join us in future events as well, inshallah. So just closing up shortly, just some housekeeping rules for your benefit. This session is being recorded. The idea is to ensure that we don't miss out on any comments and feedback that we receive. The presentation in general will be the exposure draft. So you would have received the exposure draft. If you haven't received it, it's available on our website, and the link will be shared as well in the chat shortly. You will be mostly kept on mute. In case you have any questions, please use the Q&A tab, which is at the bottom of your screen. Or if you wish to ask question by voice, please raise your hand. So the presenter will give you the opportunity. This for AOFI fellows, it's important that this webinar is being recorded, is being recognized for 1 CPD hour. So AOFI fellows is a very important thing. Additionally, over and above, if you would like to give us, get more information on the work that AOFI is doing, or you would like to get involved, or for example, maybe you're interested your institution to become a member of AOFI, please write to us at membership@aofi.com, or you can personally reach out to me at rmalik@aofi.com. I look after the standard implementation and strategic development here at AOFI. Now, why we are here today, of course, all of you are aware, we are here for a public hearing on the Financial Accounting Standard FAS 1, which is a very important standard. It's a general presentation and disclosure in the financial statements of Islamic banks and financial institutions. And to present the exposure draft to us, we are joined by the Secretary General of AOFI, Mr. Umar Mustafa Ansari, who is a very experienced and knowledgeable individual and leader within Islamic banking and finance. Prior to his current role, he was also Assistant and Deputy Secretary General at AOFI, and earlier in his life, he was a partner assurance and head of Islamic finance at EY Pakistan, heading this Pakistan and Afghanistan market. He's also a fellow member of Institute of Chartered Accountants. His key areas of expertise include assurance, advisory to Islamic financial institutions, Islamic accounting advisory, audits, and he has done a lot of work within that space, involved with different banks and financial institutions in different parts of the world. He was also formerly a member of ICAP's committee responsible for the development of Islamic accounting standards in Pakistan. And he was also the member of Securities and Exchange Commission of Pakistan's Sharia board, and was also the advisor for SOCPA in Saudi Arabia on Sharia issues concerning IFRS. The Secretary General is also a renowned international speaker, and he attends various conferences and events in different parts of the world. Given the COVID, we are left to Zoom-like platforms. And he's also author of various books in Islamic finance, Islamic microfinance, as well as on IFRS versus the the financial accounting standards. So with that, without any further ado, let me just hand it over to Brother Umar Mustafa Ansari to take you through to the next few hours, inshallah.
أعوذ بالله من الشيطان الرجيم بسم الله الرحمن الرحيم رب اشرح لي صدري ويسر لي أمري واحلل عقدة من لساني يفقهوا قولي. Thank you, Brother Rizwan, for a nice introduction of AOFI and your kind words about me. Thank you very much. And I would like to first thank all the participants. I can see the number of participants to be above 200, and I believe we have 500 plus registrations. So they say that when one door is closed, at time new doors are opened. So having this webinar option is a door opened. In past, we have been trying to do multiple public hearings in different countries, in different parts of the world. Obviously, visiting physically and having a meeting there, the public hearing meeting and meeting people physically has a different impact. But at the same time, one of the objectives of the public hearings and the primary objective of the public hearings is to make sure that maximum people attend and we are able to get maximum market feedback. So from that perspective, I believe this is a great opportunity and this is a great opening for us to hold our public hearings through webinars. Even in past, when we were doing our public hearings in Bahrain, at least we kept an option for the global audience, but the number of participants was not normally not in hundreds. So I'm very glad to see that, and I'm very thankful to all of you for your participation, and we look towards active participation. Uh, while as I mentioned, that's a new door opened. So maybe from the practical point of view, all of you may not be given an opportunity to speak, but we will try to give some opportunity to you to speak as well. But the approach would be generally that I will take you through the standard, and I'll explain the important issues and important points, and we'll take comments on each of the paragraphs, whatever we can. whatever comments are in your mind, you can put them in the Q&A chat box, put them in the Q&A box. Reason being that Q&A box will be giving us a direct list of questions, while in the chat we can find some of the general discussions and salams to each and every panelist and the participants. So with regard to question and answers, whenever you put a Q&A, my request, put the paragraph number. It will make sure that we don't miss out any question and answer when we are actually going to put them in the version for our working group and the accounting board. So these are a few requests before I take you through the standard. If you have any general comments, put general. Uh, we have one question. We have one question by now, but it is actually it's actually not exactly related to this topic. Email Musatar to contact Dr. Rizwan directly, and we will respond in due course. With that, let me take you through the standard, and before that, I may need to provide you a little bit of background as well. Just can anybody confirm that the screen is shared?
The screen is shared. Can I suggest the internet? I think there is a bit of a lag at your end.
Give me a second. Is it better now?
Yes, hopefully. Yes.
Okay. I normally keep two options available, so I've just switched over. Let's hope this one works better. This is the negative part of it. While webinar opens, these options open a lot of new doors and a lot of new opportunities to you. You are bound with the technology, and anything going on the part of any server or any service provider, you're stuck with that. So let's hope things go better during the discussion on the exposure draft. Let me just take you through a little bit background of this project, the FAS1 project, and some of you who are more familiar with the AAOIFI might be aware that this is the second exposure draft of the same standard, which means that there was exposure draft issued in the end of 2019, and then in 2020 the exposure draft, instead of holding public hearings on that exposure draft, we considered additional matters. I will explain those additional matters in due course, and with that additional matters we will be taking you through through the main issues because of which those additional matters were incorporated, and why we actually revised the exposure draft which was initially issued. Financial accounting standard number 1, FAS1, was AAOIFI's first standard, if you see, and the primary objective, the original standard which is still in place, the primary objective of the standard is to provide the general presentation and disclosure requirements in the financial statements of Islamic banks and similar financial institutions. FAS1 is the primary standard, and it applies on banks mainly, but also applies on certain other institutions. Uh, the old approach of the standard was that we had FAS1, and then we had separate standards on the Kaful list and on Islamic mutual funds. And it was mentioned that most of the other standards, like we recently issued Waqf as well, the idea was that the core principles are contained in FAS1. And those, whatever is contained in FAS1 already, has to be applied irrespective of a type of institution, while whatever is specific to the takaful, waqf, and others shall be applicable on those institutions. So it means that while FAS1 primarily was for the banks, but it had a lot of issues and lot of treatments and lot of details which were applicable on institutions other than banks as well. So we have kept the same approach. We have slightly improved the approach. I'll explain you going forward that the approach has been improved a lot. But generally speaking, the standard has been kept on the same scope, that is the general presentation and disclosures of the financial statements of Islamic banks and financial institutions. The overall idea the overall idea was that we try to contain core principles at one place, and this we have kept. But the reason for revision, why we wanted to have a revision, was a long list of issues. Some of the standards which were already being issued, which were issued by AOFI in last several years, had additional disclosure requirements which were not there in FAS 1. Our international standard setting bodies like AISB issuing IFRS and US FASB issuing US FAS, they had gone to the next level. They had issued a lot of standards in between. They have significantly improved the disclosure requirements. I can assure you that at the time when this standard was originally developed, it was in a lot of matters, it might have been ahead of the competitors or ahead of the conventional market players in respect of a number of disclosures which were required at that time, which were not even which were required or which were presented very in a very good manner as compared to other standard setting bodies. But over a period of time, and we are developing standards for nearly 30 years, and this was our one of the initial standards. So we can understand that there were lot of changes in the accounting profession, in the accounting standards by conventional institutions, in the financial accounting standards issued by AOFI. So there was not only one or two changes, or there was not only a need of minor change. Rather, there was a need of I would say that there was a need of complete overhaul for that. In the meanwhile, AOFI also started a new framework. The project of the framework was started, and the idea was that the framework should be in line with the newer practices, and it should be in line with the newer strategy of AOFI. And the newer strategy of AOFI is that we try to reconcile and we try to keep our standards close to the conventional standards, insofar as there is no Sharia issue, or insofar as there is no what you say compromise on the characteristics of Islamic finance transactions. And we believe at AOFI, we believe that Islamic finance is different, and it is not exactly the same. It's not about copying the conventional products. It's not about just making a bunch of paper which is different from the conventional and doing exactly the same thing as conventional. So we fully believe in that our overall approach of the standard setting has to be closer to IFRS and other global bodies with regard to general disclosure, general treatments. And we do not reinvent the wheel, means that we do not develop standards in the areas where the IFRS is already there, and we don't feel there is a value addition in developing a AOFI standard. This is particularly important to understand, because if you try to understand this issue of um, of as to how we reconcile with the global standard setters. Because if you go to any jurisdiction, you will find that generally IFRS or the local accounting standards which are closer to IFRS are already adopted as the regulatory accounting regime, and AOFI is applicable only on a small segment of the overall economy, that is the Islamic finance segment. So keeping our standards completely different from IFRS and others would not serve the purpose. Rather, the right strategy of getting our standards is more suitable for adoption, and making the things easier for the accountants, auditors, finance officers to implement the standards. It's important that we keep them close. We do not duplicate the standards. So in 2018, we also started a comprehensive project for standard revision, and based on that there were multiple recommendations. So one of the aspects that is in the new phase 1 is with regard to certain additional paragraphs to be added, which provide the basics and foundation of some of the accounting treatments, and the detailed treatments with regard to those are being left with the IFRS or other generally accepted accounting principles. These may include those type of transactions for which there is no primary Sharia issue. There can be minor Sharia issues, or there might be minor characterization issues with regard to some of these when you go in details. But for that we can issue either guidelines, or some of those issues can be handled in our one standard, that is this phase 1, rather than developing a whole standard. So the examples of these may be like segment reporting. There is no harm in applying the IFRS segment reporting standard. There is no harm in that. Similarly, there is no Sharia issues in that. Similarly, about translation, currency translation, the core principles provided by IFRS are more or less in line with Sharia. There might be minor issues with regard to certain specific type of investments, etc., that we will handle separately. But keeping a separate standard for translation and segment reporting would only confuse the market. Why I am putting these things? Because the new phase 1 exposure draft also handles these issues. Means that it handles a lot of small issues, and provides foundation for some of the accounting treatments and some of the disclosures for the financial reporting purpose, which are part of this overall framework of AOFI. But we do not want to reproduce whatever is written in IFRS. So we want to be more clear on that. And one more thing is there, that our new framework, and this phase 1 have actually defined very clearly the hierarchy in which the FAS versus other generally accepted accounting principles are to be applied. We will go to that and we'll discuss it in detail once we reach there. But I just wanted to give this a little bit of background. So FAS 1 project is a comprehensive one. It's going for nearly 3 years or 3.5 years now. And now we are actually reaching towards the end. Since it has a lot of overlapping, I would say, with the financial reporting framework project. So actually it was done by the same working group. So the same working group actually worked on the standard, including revision of the definitions, and some of the important considerations, like I mentioned, about the hierarchy of application and selection of accounting policies and treatments. These things are a bit overlapping in the standard with the framework as well. So it was very important to keep them aligned, and we identified that one way of keeping them aligned is to assign them to the same group of people. And thanks to that working group, which has worked very hard over several, in fact, they additionally handled 2 3 minor projects in the meanwhile as well. So thanks to them. With regard to one important aspect, that our old phase 1 included illustrative financial statements as well. We decided that when you put the illustrative financial statements in the standard, there is an issue of overlapping. Means that, for example, if there is a difference between this disclosure requirement in the standard versus a general standard requirement in another phase, there might be a confusion in the market. And we had seen some of the things, like, for example, Murabha sale amount was not being disclosed by the majority under phase 2 till the time we didn't put it very categorically in phase 28, while phase 1 illustrative financial statements were already requiring that. Secondly, we realized that the standard setters normally do not provide illustrative financial statements. Rather, they leave it to the market. But what happens that some market players, they come up with the illustrative financial statements, like you all, those of you who are accountant are well aware that the big fours and other but large accounting firms, actually they develop their own illustrative financial statements, which they use in their audits, and they provide to their clients as well, and these are generally available. But with regard to AOFI, since it's about a smaller segment of economic system, we were afraid that if we leave it all together, so it may not be issued by others. So we decided to develop it and issue it as a separate project, not as a part of the standard, in order to avoid overlapping, and not only overlapping, rather to be able to update it from time to time. So we decided that the illustrative financial statements for all type of Islamic financial institutions now onwards will be issued by AOFI, but they will be issued as a technical release, not as a standard, and they will be approved by the Technical Advisory and Interpretation Committee of AOFI rather than the AOFI board. The AOFI board will provide its input, and the TIC also primarily comprised of AOFI accounting board members, but we need to consider that this is important aspect. So this was a little bit of the background, and I can see that there are a few questions coming. So maybe let me see if there are relevant questions at this stage. Then let's take those questions now. This first question is about corporate governance principles. Second is about CSR. We are always, all these comments are welcome, but they are not on this standard. So we will be, inshallah, coming to, we will be discussing them separately. I may request Brother Rizwan to answer them separately, or request them to contact Brother Rizwan directly. The third question, the last question, is also about standards and certificate recognized by Nigerian authorities. So that is also not relevant to the standard right now. So with that, I will request that these questions we will address separately, and I request Brother Rizwan to address them separately. So with that, I will take you through the standard. And so if anybody has a general comment, and a comment or a question on the general initial background that I provided, if there is a comment or any other question on that. Okay, with that we can move ahead. And now, is there another question?
Brother Umar, there are certain hands raised.
Okay, so Brother Rizwan, if you can allow them one by one, we will see. Again, we have to be mindful of the time, but we can take quick questions if you can allow them one by one as well.
Okay, I'll allow
But,
Nihal.
but please just make sure that the questions in this one we are going to address about this standard only, or anything that is impacted by this standard. Any other questions which are
Nihal?
generally received should be sent to the question answer group.
Okay. Abir, do you have any question or comment? Arimi Mustafa, do you have any question or a comment? No, Brother Mustafa, Brother Umar, I think we can move forward.
Okay. Okay. Anyway, your questions can always be provided in the question answer box. So with that, I will share a screen again, and let's move ahead. It's a long standard. I have nearly 187 slides, so I will be skipping a few things. With regard to the background, I have already provided to you, so I'll be skipping the preface section and the introduction section, except for the list of major changes. So if anybody has any comment, if we have a comment, on preface section and the introduction section, please feel free to provide the comment with with the reference to the paragraph number after this one. But right now, I think that introduction 6, that is significant changes from previous standards, is very important. So I'm going to list it down. So there are multiple changes. It's a complete overhaul, but the major changes are as follows. The revised conceptual framework is now an integral part of AOFI phases. The conceptual framework shall assist in better interpretation and understanding of AOFI phases. However, the board clarifies the conceptual framework is not a standard in itself and cannot override any requirement of an AOFI phase. This is a very important issue. We are aware that in the market, at times it happened that AOFI did not have a standard. Like for example, on Wakala, AOFI did not have a standard till last year, till 2 years back. Now, what happened that the treatment of Wakala was mainly being happening in line with generally accepted accounting principles as a liability, and even ignoring the real characteristics of the transaction. Because if you apply the characteristics of the transaction, even under generally accepted accounting principles, the wakala transaction should be off balance sheet. So this is just one example that framework was ignored, and people refer to IFRS only. Now we have clarified that the conceptual framework is an integral part, and it must be followed. It must be followed along with the standards to make sure that the accounting treatments by Islamic financial institutions remain Sharia compliant. Definition of quasi-equity is introduced as a broader concept that will include the unrestricted investment accounts. Since beginning, AOFI standards talked about unrestricted investment accounts, URIA accounts, which were like dealt as a separate component of equity after and shown after equity and before liabilities. Over past decade, or maybe more than a decade, we have seen a lot of other transactions other than unrestricted mudarba, which are in the nature of and similar to equity in some of the elements, and are not similar to equity and are similar to liability in some of the elements. So what was decided by the board to broaden the definition and bring in the concept of quasi equity? We brought it in the framework and in the standard together. So unrestricted investment accounts, URIA, are included now in quasi-equity, and there can be other types of quasi-equity, which may include, for example, if there is a sukuk which has the similar characteristics, it will be appearing in quasi-equity. So there is a broader definition and broader concept rather than restricting it to the URIA accounts. Then we have definitions have been modified for cash and cash equivalent, income and ijara to align them with the recently issued AOFI FASs. Concept of comprehensive income has been introduced with the option to prepare one statement, that is combination of income statement and other comprehensive income statement, or to prepare the two statements separately. This was one of the major criticism on AOFI, that while IFRS started nearly 10 years back, a separate statement of comprehensive income, and some of the regulators required that, but AOFI standards were not addressing it. There were some minor Sharia issues related to that as well, because we have not only the shareholders' equity, rather we have the equity of investment account holders, or the quasi equity as well. So handling that was not very easy, but we had it on our radar that we need to improve our practices, and this has resulted in a significant revision in our standard now, and the standard is more aligned to the international best practices now. This change has resulted in number of consequential amendments as well, because there are a lot of consequential amendments, because according to AOFI standard, like it's, for example, the fair value gains were taken to equity, not to other comprehensive income. Now for most of the places where we had the concept of fair value gains going to equity, we have to route them through the statement of other comprehensive income. So this is aligning with IFRS and regulatory requirements, and reducing the unnecessary differences with the other standard setting bodies. Institutions other than financial institutions are allowed to use the current and non-current distinction for asset and liabilities to make their financial statement comparable with similar institutions that are not using AOFI FASs. Disclosure for Zakah, charity, and Qard fund have been relocated to the notes to the financial statement, thereby reducing the number of primary financial statements. Old FAS 1 had a Zakah statement, a charity statement, and Qard statement. Zakah and charity as one statement, a Qard statement as a separate statement, as a primary statement. So we have kept them, and rather we have improved the disclosure requirements, but we have taken them to the notes to the financial statement as a statement within the notes rather than as a primary statement. A true and fair override has been introduced to facilitate the institutions in presenting information fairly to users of their financial statement. This is one important thing which is in IFRS and which is rarely applied, and we also feel that it will be rarely applied, but we have provided this in the new one. The section for accounting policies and accounting estimates have been strengthened. Treatments have been introduced for change in accounting policies and estimates and correction of errors. Disclosures for related parties, subsequent events, and going concern have been improved. Presentation and disclosure requirement of financial statements have been divided into three parts. Now, this is very crucial, and this is a change in the second exposure draft, not even the first one. Part one is applicable to all institutions, mean even a takaful institution, a waqf institution, a mutual fund, they all need to apply part one. Part two is applicable only to Islamic banks and similar IFIs. And part three prescribes the authoritative status, effective date, etc. So we need to understand, and the amendments to other consequential amendments to other UFI phases, which is a long list. So with that, if you see that part one is going to be applicable on all institutions, which means that even takaful and mutual funds and other type of Islamic institutions, including WAF, the core principles of accounting will remain the same. So part one, if you can say that these are the core principles and of financial reporting and core principles of presentation and disclosure. So with that, can we take a few questions here? If anybody has a question here, we can take questions on the significant changes. So if we have any questions on the significant changes, anybody want to put them in question answer, or if anybody want to put the questions physically.
There is a question from Mufti Khwaja Nurul Hassan.
Okay, I can see that brother Khwaja Nurul Hassan, welcome brother, and thanks for your support to UFI. I always see your presence and active presence and participation. Thank you very much, dear brother. As a general comment, some definition of debt, equity, financed, disbursed, outstanding amounts, etc. may be added, or some general glossary may be developed for accounting Sharia standards, as this differ from accounting and Sharia perspective in some instances. Brother, it's a very, very valid comment, very good comment. Now, but we have to be more specific, brother. Number one, on the glossary part, we are already working on a glossary for Sharia. We are already working on a glossary for accounting. And glossary means that right now we are putting whatever is in the standards, but at the same time, we want to improve it. So the improvement will be done by the respective boards in due course. The project for Sharia glossary was started nearly 4 years back, but due to a very busy schedule of Sharia board, we could not finalize that. Accounting is an advanced stage already, and inshallah we are planning to finalize it. Maybe we will be able to publish it with the next edition of the accounting standards. It may also result in some of the amendments and uniformity of definitions, because there are at times some definitions which are not exactly uniform in different standards, and we are trying to do that uniformity as well. Brother Khwaja, if you see with regard to uh, debt, equity, I think debt we have not defined like that. We have defined in a different style. The receivables we have defined. We have not defined the debt. We have defined receivable. But equity, finance, disbursed, outstanding amounts, some of these things may be more relevant. Not from accounting perspective, but if you can suggest exactly like being more focused, that equity definition is very much there, liability definition is very much there, receivables are addressed, finance and disbursed and outstanding amount, these are not defined. These, from accounting perspective, these are actually results of transactions, and these are not actually the amounts to be reported. But again, we are open for more specific comments. Generally speaking, your main comment with regard to general grocery, for sure that is needed, and we are already, as I mentioned, we are already on an advanced stage for that. Then there is Brother Musa Zuma. It's a very good question with regard to zakah and charity funds, welfare funds required to be disclosed on the balance sheet under liabilities. Brother Musa, that is correct. What we are saying that what we are putting in is that whatever is payable to the funds appears as a liability, but once it is transferred to the fund, then it is not part of your own balance sheet. So till the time it is not transferred to the fund, but some of the institutions don't have a proper fund. So in that situation, it will appear as a liability. So let's be clear. There are two types of institution. One institution is that creates a fund and transfer the funds to that fund, transfer the zakah amount and charity amount to that fund. If a fund is there, then still the fund disclosure is required in the notes. but the liability amount will be zero, because the fund is already transferred to the fund. On the other hand, if you want to if you don't have a fund, and a lot of institutions don't have a separate fund, in that situation these will be appearing as a liability, and within the liability we will be still having that disclosure that we have mentioned. Brother Vivek, thank you for a very important point. Brother Vivek from PwC, in Qatar, there is a difference as per Central Bank for securities for which treatment is more in line with the IFRS, and they need to deviate from AOFI. Is there a view AOFI board is considering on this? Brother Vivek, thank you for raising a very important point. As I mentioned that we have already brought in the concept of other comprehensive income. So it means that not only the gains will go to other comprehensive income, but non-cyclable and cyclable and those things which were there in IFRS and not in AOFI standards will now be more similar to similar to IFRS. So we believe that the difference with the Qatar's central bank requirements will significantly reduce after application of the new standard and after incorporating the consequential amendments of FAS 1 in FAS 33. Thank you very much for a very good question, brother. So if we don't have any further general questions, or Brother Rizwan, if anybody has raised hand and want to put in a question himself.
There's a question from Dr. Abdul Razak Kaba. What are the main features that distinct quasi-equity from equity in relation to unrestricted mudaraba?
Okay, brother Dr. Abdul Razak Kaba, very good question, but allow me to reach the definition. On the definition, I'll be in a better position to explain that, sir.
I think we can continue.
Okay, thank you, brother. Okay, now we are coming to the body text of the standard. The objective of the standard: the Islamic financial institutions are required to publish periodic financial statement to satisfy the common information needs of the users as described in the conceptual framework. This standard sets out the overall requirement for presentation of financial statements, the minimum requirement for the content of financial statement. Sister Farida noted down it should be minimum requirements. I don't know, there is a typo error here. The minimum requirements for the contents, requirements for the contents of the financial statements, and the recommended structure of financial statements that facilitate faithful presentation in line with Sharia principles and rules and comparability with the institution's financial statements of previous periods and the financial statements of other institutions. So this objective is more or less in line with other financial reporting standards. I'll move through it, and we can again take comments in due course. The standard is applicable to financial statements of institutions desirous to prepare information for Sharia-compliant products and services to meet the information needs of the users of such statements. These institutions include the Islamic banks and similar IFIs who are primary subjects of this FAS, and additionally, Takaful companies, Waqf institutions, Islamic collective investment schemes, and special purpose vehicles associated with these institutions. This standard prescribes the primary statements and disclosures as applicable to A, Islamic banks and similar IFIs, and B, other types of institutions. The requirements related to other type of institutions prescribed in this FAS are general in nature. Specific requirements for each of other type of institutions are prescribed in their respective phases. Also see paragraph 26. However, in the absence of specific guidance in the respective phases, requirements of this FAS shall apply to such institutions as well. The standard is applicable to all institutions and entities desirous to prepare information for Sharia-compliant products and services regardless of their legal form, country of incorporation, or size. However, Part 2 of the standard shall be applicable only to Islamic banks and similar IFIs. This standard is equally applicable to the institutions that are presenting consolidated financial statements or the standalone or separated financial statements. This standard does not apply to structure and content of condensed or summarized financial statements prepared for interim financial reporting. We are working on a project on this one, and maybe we end up like adding some paragraphs in this one in the final one with regard to the condensed interim financial statements, or maybe we come up with a separate standard or guidelines. Any comments on objective and scope?
So there's a question on the scope.
Okay.
They're asking if we can explain if the standard applies on the conventional banks who use
Okay,
Islamic windows.
very good question, Dr. Ilyas Abul Haija. Thank you very much, brother, for a very good question. Can you explain if the standard applies on the conventional banks who use Islamic windows? Uh, the quick answer is we already have our FAS 18. FAS 18 says that those institutions, that is, number one, we are revising FAS 18 and improving it. And after improvement, it will be more aligned with this new exposure draft and it will be more aligned with the new framework. But the conceptual part of your question is already there. Number one, according to AAOIFI standards definition, Islamic financial institutions include a window. And we believe that windows should work in a manner that it's like a bank within a bank or institution within an institution with all its funds and liabilities and assets being separate. And that institution, that virtual institution, our framework also allows for virtual institutions. So the window that becomes a virtual institution should apply AOFI financial accounting standards in full. However, However, if there is a product only, not a full window, in that situation, only to the extent of that product, they can apply or they cannot apply. This is what is written as of now in FAS 18. We believe that once the FAS 18 is revised and improved, the core principle will remain the same. That means that a window, which is a full-fledged window, licensed window, which has its own assets, liabilities, and allocated equity, should be applying AOFI standards and should be putting a set of financial statements in along with the set of the conventional financial statements, which may be consolidated by the conventional institution who owns the window. However, the accounting policies and presentation of the disclosures which are required as per AOFI phases shall remain applicable to the windows. So, nutshell, if it is a proper window, yes, AOFI phase apply and AOFI phase will inshallah still continue to apply. And there are countries like Bahrain and some other places where you will find that the window actually prepares proper financial statements and which are attached there. Then there is another question, a very good question, and can you explain about Islamic social reporting? We believe that Islamic financial reporting, the financial reporting or the concept of Islamic accounting includes the social reporting elements. However, as of now, we need to understand that the regime in which these institutions are working is the commercial banking and commercial financial institutions regimes. So we have put some of the requirements in our governance standards with regard to CSR and CSR reporting. And particularly if you see that WAQF is a social institution, so in the institutions, WAQF institutions financial reporting, we have very clearly required a statement of service performance as well, which actually is about what the social impact is created by the WAQF. So we highly appreciate your comment, and we are covering it from different angles. As I mentioned, for general institutions from the CSR perspective, and for social institutions, we are putting it as an additional requirement on the financial reporting side. With that, we move ahead now towards the body text of the standard. Now we are on the definitions. Again, now I need to specify there were some important areas about significant changes, about objectives, about scope. So I was reading out the whole of the standard. Now onwards, I will be reading out only those things which require significant input, but the comments are welcome on each area. So, like for example, all definitions I may not go through, but if you have any comment on any of the definition, please feel free to provide them. The definition of assets is very close to IFRS, slightly improved from our earlier one. Cash and cash equivalents is a more clarified definition for the purpose of cash flow, and we very clearly clarified that it does not include gold, silver for this purpose of cash flows. Control is a very important definition. We have put this definition in our new framework, and we have put it in some of the standards like FAS 28, FAS 30, FAS 29, which is yet to be finalized, and some other standards. This control definition is close to IFRS, but it is slightly different as well. And at times we have provided its explanation, which is slightly different from other standard setting bodies. In a nutshell, the control, we are talking about the control definition, and we say that it's about variable returns, that is profits and losses, and about the power to affect that govern through the ability to affect those returns, that is the governance. So you need, when you say that you control an asset or business, so substantially all risk and reward incidental to ownership have to be there, and the governance right, or the right to sell and right to use, or right to put it to use, or right to put in ajara, etc., should be there. Ownership rights, what we generally say, and the right to profits and losses, which is the variable returns, negative or positive respectively. So these are the conditions for control. This definition is quite close to IFRS. Earlier we had a lot of confusions in this area, but now we have clarified this one and are using this one on a uniform basis for overall standards. Then we have definition of expense, historical cost. Some of these are coming from our earlier standards, earlier phase one. Ijara, we have a slightly improved definition, and it is in line with the Sharia standard and in line with the standard number 32 that we finalized last year. Now, income is a very important definition, and here there is one very important aspect. The definition of income is here, but it is with due consideration of the requirements of paragraph 16 to 20. And in 16 to 20, one thing is very important, that IFRS 15 has defined five-step model for revenue recognition. We did not have that model earlier, and we believe that model has merit, and is generally not against Sharia. But the main issue is when you apply that model, how you apply and interpret different parts of that model. For example, what is the expected delivery, what is the service, or what is the goods are to be provided, or whether it's a provision of finance, etc. So we will discuss it when we reach there. So in a nutshell, income definition has been improved and has been aligned with IFRS with regard to the recognition model. Islamic financial institutions, this definition is coming from our governance standards. We coined several years back for governance standards, and then we started using it we used it in our framework, and now we are reproducing it here as well. And one of the important aspect that is a response to our brother, these include the standalone branches, divisions, and windows of conventional financial institutions and SPVs. So this is very important, that we need to understand that even if an institution does not appear to be a financial institution, for Islamic financial institution, if it has a dedicated window, it will become a virtual entity and will be part of the financial institution. Similarly, a special purpose vehicle which is registered as a different type of entity will still be considered a financial institution for this purpose. Then we have the definition of istithna coming from our earlier standards. Definition of liability is an important one. There is one important clarification here. Liability is the present obligation, legal or constructive, other than quasi-equity. This is a very important point, because we have this one major difference with the IFRS and other standard setting bodies, that they do not consider quasi-equity separately. They say that if there is a put option on a part of any instrument, it will not be considered equity, it will be considered a liability. While we have defined the third category between liability and equity, that is called quasi-equity. We'll come to quasi-equity definition coming forward, but the main point is that we distinguish liability from the quasi-equity. Then we have some definitions of some of the products. Mainly these are already in our other standards, which are reproduced here. Owner's equity, brother Khwaja, this is the answer to your question. Owner's equity is the residual interest in the assets of the institution after deducting all liabilities and the quasi-equity. The difference between our definition and IFRS is only the quasi-equity element. Now coming to quasi-equity, and we had Dr. Kaba asking this question, if I'm not mistaken, about your name, sir. Uh, Quasi-equity is an element of the financial statements. Sister Farida, Can you note it down, please?
Yes, sir.
Statement. Yeah. That represents participatory contributions received by an institution on a profit sharing or participation basis. It has, number one, primary characteristics of equity, that is, in case of loss, unless negligence, misconduct, breach of contractual terms is proved, the institution is not liable to return the lost funds to the fund providers, and the fund providers share the residual interest in the underlying assets of the business. And two, certain characteristics of a liability, that is, it has a maturity or a put option of redemption oblique liquidation. Like if you have a urea account with the Islamic Bank, either it has a maturity of a period, or you can go and ask for your money anytime. So this is a redemption or liquidation from Sharia perspective. Certain and this option, this specific item number two, this is not equivalent to any type of equity that is normally prevailing in the different parts of the world. Three, certain specific features, that is, the right of fund providers are limited only to the underlying asset or business, assets or business. Sister Farida, can you recheck it? Assets or business, or asset in the, it should be in bracket, asset in bracket, or we just need to recheck it about the this one, or business, and not on the whole of the institution, as well as they do not have certain rights associated only with owner's equity. So here we are defining the quasi-equity very clearly. It has been defined earlier in the framework very well, and we had mentioned it in actually one standard earlier as well. I think in the Sukuk standard number 29 and Wakala standard number 30, we had 31, we had already mentioned it. So it is kept as the same. We just need to address, because this is a fundamental change, because earlier there was only urea accounts which were considered in this one. Now we said that other than urea accounts, there can be other elements of financial statement that are subject to the same requirement. So we expanded that definition. Do we have a question here? I think there are some questions.
There's a question on RI deposit by Munir, Brother Munir.
RIA deposit under management, where shall funds be placed in revised framework? Brother Munir, thank you very much. Very valid question. RIA, we changed the name, and again, as we changed the name for the quasi equity versus urea, we changed the names in a similar manner for the RIA, because we said that there can be more type of funds under management in addition to RIA. So one of the example is a wakala bil istismar, which is not commingled with mudarba. If wakala bil istismar is commingled with mudarba, it will be by virtue of the secondary element of commingling, will become on balance sheet and will become a part of urea or part of quasi equity. But if you see the normal wakala bil istismar, according to FAS 31, it will be considered off balance sheet, so it will be under funds under management. Similarly, RIA, RIA, if they meet the criteria of off balance sheet, because if you see FAS 27, they say that all RIA, only by putting a name RIA, will not become RIA. It means that if you go to FAS 27, which was revised several years back, 7-8 years back, FAS 27 says off balance sheet accounts. It does not say only RIA. The concept is that only putting the name RIA does not qualify for off balance sheet. Rather, you have to make sure that the characteristics of RIA are there. So if the characteristics of RIA are there, in that situation, it will be off balance sheet account. So off balance sheet assets under management include RIA, and in the new standard, in this standard, you will see we have a separate statement similar to the statement that used to be for RIA. We have a separate statement for a statement of off balance sheet assets under management, of balance sheet managed assets, which include mainly RIA, which include wakala bil istismar, which is not commingled, and which include, in case of institutions other than banks, it includes the participants' investments managed, participants' investment managed in a family takaful, where the unit linked funds, etc. So there can be different type of assets and liabilities which are managed by which are managed by the institution and on an off-balance sheet basis, because the control definition, if you see the control definition, that is important. So the control definition, if they don't meet the control definition, then they are kept off balance sheet, and in that situation they are to be managed as a off balance sheet managed assets, and all of these will be appearing in that statement. We have another question, anonymous attendee. In the draft, you give definition of historical cost, and you also talk about true and fair financial statements. I think to produce, to produce the true and fair financial statements is to use fair value, not historical cost. Brother, if you see, majority of the items that are in our financial reporting are at fair value, not all of them. But for example, according to Sharia, a receivable cannot be fair valued. Means that a receivable cannot be sold against cash or against receivable. So it means that a receivable has to be carried at cost. You cannot do the receivable fair value. This is just one example. There are other issues as well, like property, plant, and equipment accounting, which is to be done at historical cost or at fair value, because there are additional elements attached to that. So to be honest, historical cost is continuing with IFRS and will continue with IFRS and is continuing with AAOIFI and will continue with AAOIFI, because not all financial statement elements are suited to be reported at fair value. This is one. Secondly, there are type of transactions and type of balances where the fair value determination is hypothetical, and comparatively historical cost is more reliable data. So because if you want to see, there are long debates on how fair is the fair value, and these sort of debates you will find at a lot of places, not even for Islamic, but from conventional accounting perspective as well. So you need to understand that this historical cost has its own weightage for some type of institutions and some type of transactions and balances, and it will continue. We have another question from Sohila Ait Musa. I think it's a sister. I would expose a problem. Our general accounting system does not provide accounts exclusively for Islamic accounting, and therefore to set up detailed reporting specific to banks, we Central Bank encountered problems. Knowing that some banks have opened windows while others only do Islamic products. Now, with regard to, there are two issues here. It's about your reporting requirements. So if you see that reporting requirements for the central bank and the core principles, etc., IMF and IFSB have worked on that. IFSB has worked and IMF have gone for that. So some of those reporting requirements are more in the scope of IFSB. But with regard to the financial reporting, general financial reporting, sister, our point is that that AAOIFI financial accounting standards are the best suited for Islamic finance transactions. So you should put them as a requirement. Even on a window, you should put as a requirement in line with FAS 18, as I mentioned earlier. This is the only right solution to your issue. One more issue is with regard to if you are talking about the IT systems, now dedicated IT systems are available, and one of them is certified by AAOIFI as well. So that can also help on the accounting side. The next question is Murabha income required to be accrued over the finance term or to be recognized in full at inception? Brother Musa Zuma. Brother Musa, this is a question related to FAS 28. Let me quickly answer. We have FAS 28 on that. We don't do accrual. We recognize the total receivable in beginning and defer the profit, and the profit is amortized over the period of time. So since it is not related to this standard, I don't want to go into further detail for that. But we don't come with the concept of accrual. Rather, we say that according to Sharia, the sale take place at the beginning. So you recognize the sale at the full sale value, which includes the profit. And in order for doing a just and equitable distribution of profit between your stakeholders, you amortize the profit over a period of time. That is the period of the recovery. So this is the approach in our FAS 28. For further details that you need, you may drop me or Sister Farida a separate question, and we will explain in line with FAS 28, inshallah. Can you please, Brother Vivek has a question. Can you please explain more in detail what changes in Wakala instruments parameters as again in Qatar, this comes as a deviation to conventional disclosures? Brother Vivek, this is correct. Our standard number 31 is different from conventional, because conventional generally considers Islamic finance Wakala transactions as a financial instrument. We consider it as a wakala, that is principal agency relationship. So if it is a principal agency relationship, it cannot be on balance sheet. So mostly wakala bil istismar will become off balance sheet. However, we have seen a common practice of Islamic financial institutions around the globe, and even the Central Bank of Bahrain required them to do it mandatorily. That is that the common wakala product that they are offering to the common customer, they commingle that wakala with their mudarba. So it means that there is a secondary contract, the secondary internal contract of investing the wakala amounts into the mudarba fund. By virtue of the secondary contract, it becomes on balance sheet, and it becomes like urea. So this is the treatment. FAS 31 clarifies it, and we are issuing a, Sister Farida, if you can confirm, have we issued the technical release or not yet? On
Not
further,
yet, brother.
okay, on
Not
further
yet.
explanation, because a lot of issues came to our attention with regard to this wakala treatment. So we have more recently worked on a very comprehensive technical release, which is yet to be issued, but it is almost final. We are just waiting for some final touches. So shortly it will be issued. So you can approach Sister Farida for getting the technical release as soon as it is issued. It will be on the website anyway, but you can just drop an email to Sister Farida or our accounting email. Sister Farida, you can provide your email address. That will be good. So
Yes, I will provide my email
yeah,
address.
that will be good. So anybody, so what will happen that the main requirement is remain the same. We are not amending the standard, but we are clarifying some things which we needed clarification, and a lot of industry participants were writing to us with regard to clarification. So we actually plan to issue that technical release. So I think it will be issued. Okay. So with that, I think the questions that we received, are done. So let me move ahead.
There's a small question in the chat. Talks about, it's a question on ijara. What is the rule to determine rent in case of ijara? I'm not sure if it's relevant here.
Brother Amir Hussain, this question is related to FAS 32. If I try to address here, it will be a bit difficult. A quick part is how to determine rent is not accounting. How to determine rent is the business practice, which should be done in line with Sharia. How to report that, it is clarified in our FAS 32. On the lessee side, we define the accounting much closer to IFRS, and on the lessor side, our accounting is also close to IFRS, but on the operating lease side, because in our ijara transaction, the risk and reward incidental to ownership are not transferred to the lessee, and the control is not transferred to the lessee. So we keep the transaction slightly different from the conventional transaction. Instead of finance lease, we treat it more like operating lease, but the treatment on the lessee side is now more or less similar. It's not exactly similar. It has some minor differences, but this is not actually the right time, because this standard is already quite long standard. So, and we have limited time for this standard. So I'll try to skip that question for now. Okay, let's continue. We were at quasi equity. Salam, the standard definition, Sharia principles and rules. This is one difference. Sharia principles and rules were earlier defined in our governance standards, but there were some implications. So we brought it in the accounting standard as well. So now Sharia principles and rules in the context of Islamic finance and in the context of AAOIFI standard shall be considered as a hierarchy of 5 items: AOFI Sharia standards, regulations of the relevant jurisdiction related to Sharia, rulings of Central Sharia Board of the jurisdiction, requirements of AOFI FASs, which are related to Sharia, for example, timing of recognition of revenue and the allocation to different parties in line with Sharia, and the approvals and rulings given by Sharia Supervisory Board. Then we have SPV, Sukuk, Zakah. Zakat definition is also slightly improved, and we are working on a Zakat standard as well. Shortly, we will be holding public hearings on that as well, inshallah. That definition is aligned. This definition, new definition, is aligned with the new Zakat standard definition. Now, this is a very important paragraph that we have inserted. Even IFRS, you will find they have something similar to that. The financial statement shall include an explicit statement confirming compliance, confirming that IOFI phases have been followed. Sister Farida, please note it down. It should be confirming, not compliance. Confirming that IOFI phases have been followed. So compliance is an extra word. I'm not sure whether it is in the standard text or only in the presentation. So just please note it down.
Okay.
Okay. Confirming that the AOFI phases have been followed while preparing the financial statements. Again, note it down.
Okay.
While preparing the financial statements in their entirety. In the case where the institution is not following the AOFI phases in their entirety, such as due to overriding requirements of local laws and regulations, the institution shall not provide the explicit statement of compliance. In this case, the institution shall disclose the significant departures and deviations from AOFI phases accordingly. So what we are asking here is that we do not want to allow, if you want to take it in a lighter note, we don't want to allow a mixed plate, that you pick a few things from AOFI phases and pick a few things from other standards, and then you say, oh, we are compliant. Wherever you follow AOFI standards, you have to follow them in their entirety. Now, this is very important because now we have further clarified, as I mentioned initially, and we are going through the hierarchy of determining the accounting policies. It means that earlier it was a very common practice that if you don't find a AOFI FAS for any transaction, you directly refer to IFRS or any other generally accepted principles, which at times were not Sharia compliant. Or they were not like reflecting the true nature of Islamic finance transaction that was underlying that structure. So here we have put a very clear requirement, and it should be read with the hierarchy part. Now, coming to the elements, we have assets, we have liabilities, we have quasi-equity. Some of these things are in the equity as well, some of these are in the definitions as well. Now we have owner's equity, but there is an explanation to the owner's equity here, which was not there in the definitions. And that is that there can be equity other than common shares. So an instrument other than common ownership shares, including sukuk, shall be classified and accounted for as equity in the books of the institution if and only if the following conditions are met. A, the instrument is participatory in nature, that is risk and reward of the underlying assets of as business are shared by the holders of the instrument. The instrument is either perpetual or convertible in nature or a combination of both, means that it does not have a put option in the hand of the holder. Now, this is very important, this part B, because if it is not perpetual or not convertible in the hand of the issuer, it means that the holder of the instrument can come anytime and ask for its money. So if this is the situation, then it will not be an equity instrument. So this is something which was not there in earlier FAS 1, and we have brought it in because this is addressing a very important issue of some of the Islamic financial institutions who have issued tier 1 equity instruments. So here we are talking about primarily tier 1 equity instruments, which are not the common shares, but they need to meet all these conditions. The third one is the instrument is subordinate to all liabilities and quasi-equity instruments of the institution. So if all these conditions are met, in that situation, a sukuk issued as tier 1 sukuk can be shown as a part of equity for the financial reporting purposes. This is the definition of income. And as I mentioned initially, that the 5-step model of IFRS, which has no major, in fact, it has no Sharia issue. Rather, we would say that it is actually the way Sharia presumes the income recognition. So income as a result of transfer of goods or services shall be recognized based on the following 5-step model. A, identify the contract. B, identify the performance obligation. C, determine the transaction price. D, allocate the transaction price to the performance obligation. E, recognize the income as and when the institution satisfies the performance obligation. Now, this is very important. We need to understand that part, that these elements, these five-step model, which consider the performance obligation and the price, these are very much in line with Sharia. So we thought that bringing that in the standard would be streamlining the accounting practices and will be reducing the difference. However, this issue is actually more addressed in the framework, and I remember when we had public hearings on framework, we had long discussion on that one. The performance obligation might be an issue. Like our brother was asking a question about wakala. Now, if I consider wakala to be a service contract and a wakala bil istismar being a service contract, it means that my part of revenue recognition is not the whole income coming from the asset. Rather, my part is because my performance obligation is providing the investment management service. Hence, my performance obligation is only to the extent of my share of fixed fee plus variable fee or the incentive. While if we consider, we go for the so-called substance over form approach, in which we say, okay, by name it is wakala, but actually it is a deposit, so it's a liability. In that situation, the performance obligation will become different, and this section will not apply. Rather, under IFRS 9 will apply. These are the issues that we are trying to handle, that we are insisting again and again on the right characterization of the transactions in line with Sharia principles and rules. And we believe that when the transactions are rightly characterized, this 5-step model is very relevant. However, we have one more criteria here. 18. The institution recognizes income over time if one of the following criteria is met. A, the customer simultaneously correspondingly receives and consumes all of the benefits provided by the institution. The institution's performance creates or enhances an asset that the customer controls as the asset is created, or the institution's performance does not create an asset with an alternative use to the institution, and it has enforceable right to payment for performance completed to date. This is very much relevant to some of the Islamic finance transactions, including istisna, and we might need to come up with a revised istisna standard. We have already commenced the project, because if we follow this 5-step model, and if we follow the new conceptual framework, which also has this 5-step model, it means that our istisna standard as of now, which is according to the old construction contract accounting model, needs to be revised. And we have actually started the project, and we'll go through the actual need of the revision of the standard in due course. If the institution does not satisfy its performance obligation over time, it satisfies it at a point in time. To be considered income, the gross increases in assets or gross decreases in liabilities should not be the result of investment by or distribution to owners, or investment or withdrawal by quasi-equity holders. These are some clarifications to make sure the income recognition is in line with the standard. Do we have any other questions here, brother, before I move forward? Brother Rizwan?
We have few questions actually.
Okay, let me take the questions now.
I think from Mr. Yamin Abdul
Yeah.
Sattar, have we defined significant departure?
Okay, very good question, brother. I mean, Abdul Sattar, this is what about the significant departure? I think it's about, we are talking about the statement of compliance with the UFI FASs. Brother, a significant departure would be a material departure. Materiality is a well understood term in the accounting and auditing profession. So when we say significant departure, it should be considered material. Maybe, Sister Farida, if you can note it down, we
Yes,
can consider, based on this comment, we can take it to the working group if they want to change the term significant to material, or if they want to define that significant properly. Because significant we haven't defined,
we
we
haven't.
understand it like material, but I would say better to use either material departure or to or to define what significant means here. Thank you very much, brother. It's a very good point. We need to define it clearly. Okay, brother Anwar Hussain has Muhammad Anwar Hussain has a question. In the way of Murabha mode of investment, can it be done without holding the goods under the custody of the client as we do in Bemojal, but profit will be determined at the early stage of buy and sale? Sir, the question of Murabha, we don't need to hoard the goods. It is very clear. We can sell the goods as soon as possible. So hoarding is not necessary. As soon as you purchase and take the risk and reward, even for a limited time, after that you can sell it. So the profit will be determined at the early stage, because profit cannot be determined later. It is very clear as per Sharia. So profit you cannot keep pending on a future date to determine. Brother Anwar, the quick answer is yes. The goods, according to our standard number 28 and according to Sharia standard number 8, I remember, on Murabha, holding the goods for a period of time is not necessary. You can sell them as soon as you purchase them. The condition is only that you acquire the full risk and reward, ownership and control of the goods. So I think that holding is not necessary. And it's not a part of our revenue recognition model. Can charges levied for non-compliance to terms and conditions be recorded under income to the IFI? Very good question, brother. But again, this is not an accounting issue, sir. This is a business issue and a Sharia issue. So first thing is, if it is a business decision to charge that amount, number one. Number two, if that is a business decision, whether the Sharia has approved it or not. Some of the penalties and charges are considered Sharia non-compliant, some are considered compliant. So I do not want to give a clear statement here. So just I would put the accounting rule here only. Any charges that are compliant with Sharia, which are approved by Sharia, will be recognized according to the 5-step model. When that it becomes like there is no uncertainty, this is like, the obligation, everything is clear. And particularly, there is one condition that we say that in the income recognition, that there is no significant uncertainty attached to its recoverability. So once those conditions are met from Sharia side, you will apply the accounting treatment and then you do it. Charging the levy, again, it's not my conclusion here as the accounting side. From the Sharia side, there are a lot of charges which are impermissible. Some of them are permissible. You have to refer to Sharia. We have a question from Kushan Tugana. Why most of Islamic banks do not consider Musharaka and Mudarba? Sadly, note that 90% incomes come from Murabha and Tawarruk. What are the advantages and disadvantages? I'm very sorry, from the name I cannot recognize brother or sister. My apologies for that. In a nutshell, this is also not again part of our discussion today. It's not related to this standard. My submission, very important, is Islamic finance is about risk sharing. It's not only about profit and loss sharing. Risk sharing means that even if there, even if a salam transaction, even if a murabah transaction is done with proper risk sharing and taking a risk, then it is Sharia compliant. وَحَلَّ اللَّهُ الْبَيْعَ وَحَرَّمَ الرِّبَا. So it's compliant. So, but it means that those transactions should also be done in a real manner. With regard to tawarruq, AOFI Sharia standard clearly says that it should not be a common form of transaction. OIC Islamic Fiqh Academy does not allow it. So for sure, we are not here to support tawarruq. We believe that tawarruq is not the right mode of Islamic finance. However, for murabaha, I would say that if the murabaha is done according to full terms and conditions as specified by Sharia, and real risk sharing is there, and risk taking and risk sharing is there, then it is equally good like musharaka and mudarba. So I don't want to go in further detail for this one right now, because that will not be that is not a topic for our today's discussion. Then we have one question from Huda Saleh. How can do I get loans from traditional bank? How can disclose in the financial statement? Honestly, this question is not very clear to me, uh, uh, because the traditional banks loans are not part of Islamic finance. Normally, Islamic financial institutions don't give a loan. They do Islamic finance transactions as a sale purchase, but it is not as a main transaction. So I think we cannot handle that. Just one question in between. I don't know why it comes in between. Is it allowed to take government subsidy as part of or Mojal profit portion? For sure, it's a business matter. So if you receive it directly from the customer, or if you receive it from the government as a subsidy, I believe it will be generally allowed. But the whole structure needs to be checked, because it's not only about saying by word. It has to be, we have to go through the transaction documents, and we have to go through the mode under which the subsidy is being provided. But generally speaking, answer is yes. But again, it's less relevant to our today's discussion. I don't know what's happening, that some of the questions are coming in between.
Because they probably are typing the question as they speak. So
Okay.
as you are answering, there's a question in the chat. It's asking whether all the items of expenses and or income of income statement are to be recognized on accrual basis, or is there any exception for any expense or income which should be recognized only on cash basis?
A very good question. Generally, accrual basis is the one that we apply. However, there are some issues. Let me just take you through. I think let me. There is one important clause where I need to draw your attention. Then you. This point E. We are talking about accrual. So accrual will generally apply. However, the income will be recognized as and when the institution satisfies a performance obligation and transfer the control either at a point in time or over a period of time. So generally speaking, it will be accrual basis. However, there can be situations where a specific point in time is involved. So let me put example of, like, for example, salam. In salam, how we recognize the profit. We do not earn profit from purchase. We earn profit from sale. So the first part of the transaction is actually getting us the goods. So putting an accrual will not be justified. However, once you get the goods and you sell them in the market, that is the time when you are able to actually recognize the profit. So it will be at a point in time. So Why we are not doing an accrual here? Because the salam capital that we pay is a receivable, and Sharia does not allow you to have a accrual on receivable which is equivalent to riba. So this is just one example that there can be some type of transactions where a point in time transaction will happen rather than a general accrual transaction. This may apply to some other transactions as well. Similarly, there is a general concept in accounting side, and that is that revenue is recognized when there is no significant uncertainty with regard to its recoverability. And I think we have addressed it in the framework, not here. So, but it means that there is no significant risk with regard to its recoverability. So those transactions where there is a risk of uncertain income, those are also recognized at a point in time rather than on an accrual basis. So do we have any other question, Brother Rizwan, before we move ahead?
I think we can continue.
Okay, thank you, brother. So now we are coming to complete set of financial statements. So we have talked about elements. Now what should be the complete set of financial statements?
Brother Omar, because you're going to into the details, there is one particular question that just come in. It talks about when recognizing income, does it address on when performance obligations are achieved based on milestones?
No, just if can you let me see the question?
Okay.
It is on the chat window or in the?
No, it's in the Q&A.
In the Q&A.
It's the last one.
Okay. This is the last one. Aminullah Nasir, brother Aminullah
Yes.
Nasir, when recognizing income, does it address on when performance obligation are achieved based on milestones, or it is same as recognizing at point in time? Very good question, brother. It can be based on milestones because it depends on the performance obligation and as to how you allocate it. So if the performance obligation is in one go, it will be happening on one go. In some situations, it can be on milestones. But the old method of milestone, like istasna accounting, which was in line with the construction contract accounting on based on percentage of completion method, it will be applicable only when the performance obligation is delivered to be, is considered to be construction. If the performance obligation is considered to be sale, then it will be in a point in time. So let me clarify it. For example, you ask me to construct a house for you. So my performance obligation in this one is construction. In this situation, I can do on a percentage of completion basis or milestone basis. If you want, if you said, Mr. Omar, you construct a house and I will purchase from you the constructed house. So in this situation, the performance obligation is delivery of house. So in this situation, it will be at a point in time. So each situation of the transaction, including Islamic finance transactions, has to be addressed from that perspective. So when the performance obligation is also on milestones, or when the performance obligation is related to a service or to a delivery in different stages, etc., in those situations it will be on milestones basis. When there is a situation where we have a where we have a performance obligation which is in one go, like delivery of the whole constructed house and transfer of the title, in that situation performance obligation is in one go, and the revenue recognition is also in one go. I hope it resolves your query. Let's come back to the complete set of financial statements. Okay, so complete set of financial statements include, number one, the statement of financial position, that is also called balance sheet, the statement of income and other comprehensive income for the period, or a statement of income and statement of other comprehensive income. Means that it can be one statement or two statements. Statement of income and attribution related to quasi-equity for the financial reporting period. This is a new statement. It was not there in AOFI. And actually, it is not there in any type of financial reporting across the globe. The concept is that why we are different from conventional institutions. The main factor is that our business model is different, and our business model is developed in a manner that we have a lot of quasi-equity balances. In some of the banks, the quasi-equity balances would be up to 70% of the balance sheet, or even more than that. So we are talking about making a statement where the balances, income, expenses related to the quasi equity are identified separately. Uh, it is not simply a computation, because obviously the computation is done on a monthly basis, not on an annual basis. Secondly, the computation is done at times for different pools, not in one go, because some institution may have a single pool, but there will be a lot of institutions around the globe which may have a multiple profit and loss sharing pools. So you cannot apply one simple solution to that as a computation. So it's not the computation, it is attribution. We are mentioning and we are identifying that we don't have only shareholders who are the owners of the institution, rather we have the quasi equity holders who are owners of the underlying assets of the business. So this statement is there to identify their proportionate share of income and expenses, and how much mudarib share or the wakala fee has been taken by the owners, that is the equity owners. So this is a very important new statement that we have introduced. Then there is a statement of changes in owner's equity, statement of cash flows, statement of changes in off-balance sheet assets under management. This answers the question to our brother who was talking about RIA. So as I mentioned, the RIA accounts and the RIA accounts, as well as the off-balance sheet wakala accounts and any other assets under management, as for example, I mentioned in Takaful, the participants investments, with the unit linked investments, etc. So these are all off balance sheet assets under management. They are not part of your, they are not in your control. You are governing them in the fiduciary capacity. You are managing them in a fiduciary and trustee relationship. So it means that you should be disclosing them. We are not saying that you just keep them off balance sheet and don't disclose. Rather, a proper statement of off balance sheet assets is needed. You need to provide the opening and closing balance as well as the changes. So this is one of the important statements which is there, and it's an improved version of the earlier statement of off-balance sheet assets, off-balance sheet investment accounts, or the RIA accounts. Notes comprising significant accounting policies and other explanations. So these are the primary statements. Complete set of financial statement include these. An institution may present a single statement of income or other comprehensive income, or a statement of income and a statement of other comprehensive income. So there is a choice, either you make one statement or two statements. This choice is as per IFRS. IFRS also has this choice. The sources and application of Zakah and charity, and sources and uses of funds in the Qard fund shall be disclosed as separate notes to the financial statements, as prescribed in generally accepted accounting principles, as applicable in the jurisdiction of the institution. Institution requiring special considerations such as takaful, waqf, collective investment schemes, etc., shall refer to their respective phases for preparation of financial statements. These entities may replace certain statements referred in paragraph 23 or provide additional statements according to the requirements of the respective phases. Do we have a comment here? Any question? I think there is more question. There are questions here.
Yes, there are a couple of questions.
We again have the question about some company to borrow from the traditional bank. Our financial reporting standards are primarily not applicable to common entities. They are applicable on Islamic financial institutions. So that company will be doing its accounting under IFRS or other generally accepted accounting principles, which are applicable in that country.
I think we can continue.
True and fair presentation. We are talking about here true and fair presentation, as well as a little bit of allowing a little bit of like, as I mentioned, that we have allowed the true and fair override as well. In paragraph 29, we say, in extremely rare situation, there can be a departure from the requirements of the FAS, but obviously there has to be proper disclosure, and it should be not on a compromise with Sharia principles and rules, and the respective Sharia supervisory board has to approve that. Then we have a section on accounting policies and estimates, how to determine the accounting policies and what are the basis of estimates. Accounting policy shall be considered inappropriate if it is not in accordance with the AAOIFI FAS, a departure from Sharia principles and rules, or not reflective of the economic nature of the transaction. So we are very clear that any accounting policy which is developed disregarding AAOIFI FAS or the Sharia principles and rules will not be considered a compliance of AAOIFI FAS. Application of an appropriate accounting policy cannot be rectified by making the disclosure of the policy. So just making a disclosure of the policy would not be good enough to justify that accounting policy. Okay, we use that different accounting policy, but we made a disclosure. That is not sufficient. The accounting policies should be developed according to these guidelines. The following are the minimum. They should represent a choice amongst acceptable alternatives. They should be adopted by the management of the institution for income gain loss. The accounting policy is adopted by institution management for recognition and determination of impairment and credit losses. So these are the more important accounting policies which should be there. And they must be disclosed in a single note at the appropriate place. Change in accounting policy. Now, this is one thing, change in accounting policy. IFRS has a separate standard on that, although some of the requirements are in IS1 as well. But the main standard is that they have a separate standard on that. So we do not want to put all the details here. So we have put in some of the main treatments, the core principles of change in accounting policy we have contained in the new FAS 1. Old FAS 1 was touching upon the topic, but this is, I would say that this is a very comprehensive summary. It is written in very brief, but it covers the most important aspects of the changes in accounting policy. Do we have any comments on that? So this is the treatment for changes in accounting policies, which we have brought in FAS 1, and it is aligned significantly with IFRS and other generally accepted accounting principles. Then what about change in accounting estimate and what is the effect, correction of an error, disclosure requirements for the correction and error, change in accounting policy and change in estimate disclosure requirements. Do we have any comments here? One important aspect is that whenever there is a change in accounting policy, the impact which is related to quasi-equity need to be identified and determined and allocated. Not only determined, but allocated. Do we have a question, brother?
No, brother, we can continue.
Okay, coming to contractual requirements and Sharia approval, any adjustment made to current period balances. This is very important aspect, and this is very specific to AOFI because this is not in line with IFRS. It's actually in addition to IFRS requirements. Any adjustment made to the current period balance due to prior period event, transaction, or condition shall be made after approval of the IFI Sharia board. The effect on change in accounting policy or correction of an error shall be based on both the contractual and Sharia requirements. The institution shall disclose the effect of any change in accounting policy or correction of an error on the quasi-equity and owner's equity respectively for the current and prior periods. So this is very important that whenever there is a change, you cannot just put it in the shareholders or the equity. You have to allocate it appropriately to the quasi-equity as well. A third balance sheet requirement was earlier not there in AOFI. It was there in IFRS. So some of the institution, in case of change, they were putting in and some were not. But now we have a clear requirement of third balance sheet. Very important point we are saying that where the Sharia principles and rules are not available, the management will assume constructive liquidation with creation or charge to reserve. If the adjustment relates to impairment or loss to investment, the management may decide to charge it to investment as reserve or any other directly attributable reserve. Other adjustments may be charged to the profit equalization reserve or to any other available reserve, or in their absence as a negative balance to respective equity. Now, this is very important aspect, and these are more specific to Islamic financial institutions. These are not related to general institutions because these are the specific issues applicable to Islamic financial institutions which we addressed here. Do we have
excuse me, Brother Umar? Yes,
Yeah.
we have a question for paragraph 50 by Mufti Khwaja. He's asking if adjustment will be made to current date or will it be backdated?
This is what we are saying, brother Khaja, that we will what will happen, that we will be making an estimate of the previous effect, because the accounting changes are from the previous year. So that's next three paragraphs are actually talking about the same thing, that how to allocate the period, what is related to the prior period. So the idea what we are giving is that if reserves are available, you can adjust that to reserve or add to that reserve, because making allocation on a backdated basis might not be easy, but you need to allocate them to the respective parties, and then it can be taken as a negative reserve also as well, so that it can be amortized it can be recognized over a period of time. So we believe that it will be according to accounting practices. If you identify an error, or if there is an accounting policy change, or something that affects the prior period as well, the effect for the prior period will be taken. This is as per IFRS. However, IFRS does not consider the quasi-equity, so they take it directly to the equity of the shareholders. Now, we are talking about taking the effects proportionately according to the contractual and Sharia requirements. That's why we are talking about contractual and Sharia, both requirements, that what is mentioned there. And based on that, constructive liquidation will be still assumed. So we will not ask the people to bring money from their home, or will not send checks to their houses, or will not credit their accounts directly. Rather, what we will do, we will be putting the things initially in the reserve. So we will create a reserve or charge to a reserve. Paragraph 53 is actually addressing this issue. Is it clear, Brother Khaja, or is there anything that I did not clarify? Because this is a very important issue, and this is one of the areas where we are different from the conventional. Okay, do we have any other question on this?
No, sir. No more questions for now.
Okay, so let's move ahead then. I was seeing the number of participants to be 200 plus. It's right now 223, and I was afraid that there will be too many questions and it will be difficult to handle. But I think majority today is in a mode of listening.
Brother Umar, Mufti Khaja has replied that yes, his query was cleared, but he says that backdated may be avoided. I think he's given a statement here.
Okay, Brother Khaja, we have considered this thing multiple times, because one option was that we go for the future only. Then the problem is that if then the effect will go only to the shareholders. So if the effect only goes to the shareholders, then what happens? This is also like a misallocation between the parties. So backdated, again, there are a few things. Right now we are talking about correction of an error or a change in accounting policy. For a change in accounting policy, even if I agree with you that okay, it should be done in future. So I agree that change in accounting policy can be applied on a prospective basis, although it's not in line with other accounting standards. But we say okay, AOFI should be doing it on a prospective basis. But errors need to be corrected from where they happened. So they need to be adjusted on the past financial statements as well. So, and we need to present the three financial statements, three balance sheets, identifying what was the impact. However, I'm just mentioning my view, sir. We will take your view to the working group for sure. All the comments which we are receiving, they will be taken to the working group, except for general questions. So if there is a general question which I responded, that's okay. But otherwise, all comments will be taken to the working group. And let's discuss with the working group this point, that shall we keep it on a prospective basis only, just to make sure that it does not impact the past in the past distributions to the investment account holders and the quasi equity. So let's put it as a question to the working group, and then we will see.
There's a point on the chat. Can one recognize the revenue after the IFRS 15 steps, even if cash is not received? So
Yes.
what happens if you don't receive
Cash
cash?
receiving is not a condition if there is no significant uncertainty attached to that. So cash receiving is not a condition. It becomes a receivable. This is all about Islamic banking. If you see, receivable is there. So revenue can be recognized with even if cash is not received. Now coming to general presentation, so there is some basic information that is requested in paragraph 54, 55, 55 continuity. So there is a general information about the institution, about the framework, about its subsidiaries, holding company. These things are and these are some general requirements with regard to the notes, with regard to some of the financial statement elements. So these are with regard to zakah, with regard to tax, some of the disclosures requirements. These are about the general requirement. Then we have the statement of sources and application of zakah. This one, because as we are working on the zakah standard already, this one will be updated and aligned with zakah standard. So we do not want to finalize it now till the time we don't finalize the zakah standard, because we are already working on that one. Then we have the disclosure for sources and application of charity. Earlier there was one statement for zakah and charity. Now we have removed the primary statement. We have put them in the notes, but we have asked for separate statements. So zakah will be separate and charity will be separate. Then sources and uses of funds and qard fund. This was also a primary statement, but this is not very common, but we have put it in the notes also because this is not part of the primary statements. Then there are issues about currency, transaction. Very quick, brief requirements are here. Maybe we will withdraw our standard on the standard on the foreign currency translation that we have as of now, and we can address only the Sharia issues related to that, particularly for a subsidiary, etc., which is acquired subsidiary or associate, which has some elements of investment from the quasi equity. Some of those things may be addressed because some of the exchange gain and losses which are treated differently may be relevant to the quasi equity. The same applies to segment reporting, that by putting some of the segment reporting requirements here, we will be withdrawing the segment reporting standard from our standards. It will not be a separate standard. Rather, the core and the primary requirements on a brief basis are included here, while remaining details may be left to the IFRS and other generally accepted accounting principles. And with regard to the banks and insurance, a lot of regulators have their own segment reporting requirements as well, because at times the banks have given a format under which different segments of business are reported. So we leave it, the primary requirements are here without going into too much detail, but details are left to IFRS and regulators. Sorry. Sharia non-compliant transaction. This is an important disclosure. The financial statement shall disclose the amount and nature of earnings that have been realized from sources or means that are not compliant with Sharia principles and rules, along with the reasons for entering into such transaction. Disclosure shall also be made of the amount and nature of expenditures for purposes that are not compliant with Sharia principles and rules. The institution shall also disclose how it intends to dispose of the assets generated by Sharia non-compliant earnings or acquired through Sharia non-compliant expenditures. The institution shall disclose the amount marked out of these Sharia non-compliant activities for charity by its Sharia supervisory board. So these are some very specific requirements which we have put in very clear form were to be reported in the financial statements. Then we have requirements on the classification with regard to maturity, etc. So classification as per maturity, etc. Then compensating balances. If the institution have any compensating balances arrangement, they should be disclosed. Contingencies and commitment disclosure requirements are there. Subsequent events need to be disclosed. Again, we are not going in too much detail on the subsequent events. Further details are available in IFRS. So we do not want to, as I mentioned initially, that we do not want to reproduce whatever is in IFRS. Rather, we want to put in the brief reporting requirements, and the remaining will be with IFRS. So this way, our standards will be more aligned with IFRS, although still there are significant differences between our standards and IFRS with regard to characterization of transaction, with regard to certain Sharia principles and rules, but unnecessary differences by way of this we are trying to avoid. A disclosure about restricted or encumbered assets is required. Then we have related party transactions. So if there are any transactions, which again, related party transactions, IFRS consider them from the perspective of true and fair reporting, but we consider them from additional aspects of trustworthiness and the level of fiduciary responsibility as well. But the main disclosure requirements more or less remain the same. Here, I would like to take any comments. So these are the sections on the subsequent events, on the related party, on the charity, on the Sharia non-compliant income. So these are general disclosure requirements that we have. And as I mentioned, because it's a very long standard actually. So I'll not be able to go through one by one, but we are open to take comments on any paragraph that you may have. Brother Rizwan, I can see we have some comments now.
Yes, we have a couple of, again, leading on points by Mufti Khwaja Nurul Hassan. It says,
I don't know, somehow the sequence of the questions go in my
true, it goes up and down.
yeah.
It says that on the basis of constructive liquidation, current shareholders at deposit.
Can just somebody do one favor? The questions which are responded, can somebody dismiss them?
I'll
Just
do
save.
it.
Yeah. So,
Yes.
so in that situation, we have only the questions which are not yet responded. Yeah, Brother Rizwan, where is the question by Brother Mufti Khwaja?
I think it was a comment.
Yeah.
Then his point is may not be directly related to this FAS. However, any comments on the current remunerative account, Mudarba-based reporting perspective?
Uh, Brother Khwaja, if I understand correctly, you are talking about a remunerative current account, which is Mudarba based. From our definition, it will not be a liability. It will be in urea and quasi equity because the risk factor is there. So we do not distinguish as current account or saving account or deposit account. We distinguish according to the characterization of the transaction. So if the transaction is Mudarba, which means there is a risk of profit and loss sharing, then in that situation, we will consider it as a part of quasi equity. We will not consider it part of liability. So current accounts, we normally show as a part of liability because they are based on qard. We do not put them because they are due immediately or because of the nature of business. So it's not the business model, it's the risk characterization of the transaction that is the basis of reporting from the financial reporting perspective.
Okay, then there is a point by Brother Hikmatyar from IARA. While SSB report is the subject of governance standard, however, it is to mention for disclosure purposes that in several jurisdictions, we have seen the reports of SSB are just formality for Sharia compliance. The report may be enhanced via inclusion of material information with respect to non-compliant income and its treatment.
Thank you very much, Brother Hikmatyar. Very good question. Let me just mention that AOFI and IFSB are presently working on a comprehensive Sharia governance framework, which will be like shortly, inshallah, available. It may take like a little bit time because there are two bodies involved and both their boards and technical committees are involved. So it may take a little bit time, but the first draft version of the standard is now ready and it's being presented to the working group going forward. So in that one, a very significantly enhanced Sharia board report has been included, inshallah. And going forward, inshallah, you will see that much better report is there. But still, you mentioned about the charity and what else you mentioned about the
Impure
question
income.
because answering should not have been dismissed.
Impure income.
Yeah, and the
Impure
charity.
income.
Okay, yeah, these are covered. These are covered in that one. That
Okay.
inshallah it will be in the final one. It will be covered, inshallah.
A couple of points, I think, again, leading on from earlier answer on related to cash. The question is, so what happened if you don't receive the cash at all? Does that mean IFRS 16 apply?
The counter means that the contra entry is that what we receive is not cash. What we receive is something different than cash. So we provide a service and we receive, rather than cash, we receive an asset. I think that that even the model is clear. The 5-step model is clear. Whatever you receive, even if you don't receive a cash, that is the price. According to the 5-step model, that asset or whatever you receive is the price. You need to assign the price a value, and that price, whatever value is assigned to them, will become the historical cost of that property, plant and equipment or inventory, whatever you receive, because it will be according a classification according to, it may be investment property, it may be a property, plant and equipment or fixed asset, it may be a inventory item. So whatever is there, it is the price. So price, you need to assign a value to the price, and the same 5-step model applies. So, but for that asset going forward, the whatever price has been assigned for that, it will become the historical cost going forward. Brother Mufti Khwaja Nurul Hassan has another question. Some disclosure of accounts maintained by IBI on the basis of current Mudarba base. Further understand the carry forward balance and during year charity amount will be reflected. First part, sir. We take it to the we take it to the illustratives. We'll consider in the illustratives. So, Majan, if you can note it down, it will should be noted for the illustratives. That okay. And
Okay.
the carry forward balances, yes, the charity amount, charity account should be reflecting both current and prior year. Means that corresponding will be there, and which will include the carry forward opening balance, and then during the year charity, and then how much is paid, and then the closing balance. So this is a movement like that. Underlying mode to disclose the charity account, as some IBIs maintain this on current account basis and take benefit from it. Now this is a different issue. It's not an accounting issue, sir. It's a Sharia issue and a governance issue. From governance standpoint, I think we will be addressing something like this in the framework in the combined framework of AOFI and FSB. Uh, uh, Brother Rizwan, if you can just note it down this point and forward to the governance team to make sure that this is incorporated. I hope it will be handled. No, sir.
Okay,
It
there's
cannot
another.
be handled from the accounting side, sir. The charity can, because underlying mode, if you just want to have a investment disclosure, that we can have. Okay. So if you want to say that if there is an investment of the charity fund, you need to make a disclosure of that. I think we can handle that one. Let's take it to the working group. Got your point now. You want, if I understand correctly now, you want that the charity fund statement should mention where the charity fund accounts have been invested. So is it current account? Is it investment account with the same bank or with some other bank in some of the securities or whatever it is? So you need to disclose that part. So got your point. I think it is covered somewhere. I think it is covered, but if it is not covered, we will add it. Thank you very much.
Brother Umar, there's a comment. I was told Murabha margin cannot be in reducing balance. If this is true, kindly explain why.
Where it is, from where
It's in
comment?
the chat. It's in the chat.
Okay, first thing is I request all of you to not to put in the chat window. Please put it in the Q&A window so that we don't miss out. In the chat window, I need to understand the question properly. Can you, I need to, in the chat window, I can't find it, where it is.
1208 Nuhu Idris.
Okay. Okay, what I try to understand first, you have used the term Murabha margin we don't use the term Murabha margin in OFI standard. So I assume you are talking about Murabha profit. Number two, you are talking about not reducing balance. So I believe that you are talking about amortization of Murabha profit. This is my understanding based on what you have written, because I'm using the words which are more common in the OFI Sharia standard, like accounting standards. The answer is, our FAS 28, FAS 2, which was the old standard on Murabha, did not have, it said that it should be amortized on a systematic method. So it was keeping quiet on what systematic method is there. So we normally used to prefer the state line method. Now the new standard number 28 allows it to be done on a time proportionate basis, and it explains that time proportionate basis can be an effective profit rate method. So considering these points, I can say that considering these points, I can say that according to FAS 28, yes, it can be on a reducing balance, means effective profit rate method can be applied to explain. With regard to with regard to whether applying a effective profit rate method or effective, conventionally what people call effective interest rate method, I would like to clarify that our effective profit rate method is slightly different from the effective interest rate method of the conventional accounting. Number one, we make sure that the timing of recognition is as per Sharia. So we talk about time value of economic resources. We don't talk about time value of money. Number one. So we starting point is at time different from conventional. The starting point is when they recognize when they recognize the cash outflow, while from our perspective it is when the asset is asset which is subject to transaction is available and delivered. Number two, we recognize the full amount of receivable and we amortize the deferred profit, while on the conventional side the principal is recognized and the interest is accrued there. So these are the main differences, but there are some other differences as well. So in a nutshell, yes, we are now applying our FAS 28.9 now applies the reducing balance or the effective profit rate method for amortization of Murabha profits, and it is similar manner it is allowed in some other transactions, including the investments which are held at amortized cost, as well as some of the Ijara transactions.
Then there is, Brother Umar, another question just underneath that by Mr. Ashraf Kadam.
Can I request all of you to please copy your questions from the chat window and put them in Q&A so that it's easier for us to answer. At times it is difficult for us to find out in the chat window.
The question is, if one type of URIA account sharing only 9% of the account, would the 10% presented in current account, or what is the correct treatment of such situation?
Again, this question is not very clear to me. Let me read it. Where it is. If one type of URIA account sharing only 90% of the account, would the 10% presented in current account? What is the current treatment? Honestly, I cannot understand this question. Can you kindly rephrase your question and put it in the question and answer box? Because honestly, I'm unable to understand. My apologies.
There's a question again on the other side. What is the items? What items will be in the new statement of income for quasi-equity?
The old quasi equity old statement of the old AOIFI statement of income was initially showing a few things related to quasi equity and then was going to the remaining items. The new statement, if you see that what we are putting in new is more like the question should not be removed while I'm answering it, sister, please. I lose concentration actually. So once I answer, please remove after that only. Okay. The earlier income statement of AOIFI FAS 1 was starting from the balances related to quasi-equity and attributing the Mudarib share, etc. in that statement, and then coming to other balances. There were some issues with regard to impairment and others, whether you show it in the beginning or you show it in the end. IFRS show them towards the end, while if you show them in the beginning, because they are majority part of them is related to the quasi-equity, then the presentation was not very good and at time not comparable. So what we did was that we made the income statement and other comprehensive income statement very close to IFRS. So you will see it in the illustratives and in the minimum contents that are required by our standard FAS 1, that the reporting is more combined on the income statement. So income statement is not showing things separately, while the old income statement was showing things separately. But as I mentioned, we inserted a new statement. Now the new statement is the income statement plus other comprehensive income statement, which is identifying whatever is related to quasi-equity. So the income statement and the comprehensive income statement is combined it's very close to IFRS and financial reporting frameworks that are accepted by different regulators, and the financial reporting and disclosure requirements that are put in by different regulators. So this way we have tried to streamline our main income statement with the generally accepted accounting principles. But we did not, for doing that, we did not want to compromise on the specific nature of Islamic finance, where our transaction structures are different and our business model is different, and quasi equity has a significant stake in us. So we decided that there will be a separate statement for quasi equity. Now this quasi equity statement is more like a disclosure statement, not a balance sheet or income statement, because balance sheet and income statement and other comprehensive statement and a statement of change in equity, these are part of double entry bookkeeping. You cannot complete your financial statements unless you account for the balance sheet, income statement, and other comprehensive income, and the statement of change equity. But cash flow, for example, is a disclosure statement. So when you do cash flow, it has nothing to do with double entry bookkeeping. It's just a presentation and disclosure requirement that you make according to the data available. So this is the difference between the two types. Here we are talking about a combined income statement, not segregating in the income statement what is related to the quasi equity, and putting a completely different statement which is providing all data related to quasi equity. We felt as the board that this is a better mode of presenting the things closer to IFRS, closer to the regulatory reporting requirements, and still not compromising on the core of Islamic finance, and not making sure that the relevant disclosure for quasi equity are done. We have another question. Is there any specific disclosure requirements on PER? Disclosure requirements on PER are included in FAS 35. They are not part of this one. But in the illustratives, they are there. Just note down this point. Sister Farida and Marjan, please note down this point. We just need to make sure that proper disclosure is there, and we will put it we will put it to the working group also, that because FAS 35 have those disclosures already, but do they want these disclosures to be part of FAS 1 or not? PER and IRR both. Okay.
Okay.
And some of the disclosures of IRR and PR are also addressed in FAS 30, but FAS 35 is the one that specifically addressed to them. So, but as of now, whatever disclosure requirements are there for PR and IRR, they are contained in FAS 35. Whether to duplicate them in FAS 1, it is that much necessary. That is what we need to take it to the working group, and we just need to make sure that illustratives have them very properly.
Okay.
Okay. Next question is whether the conservation principle is adopted in Islamic financial statements. Conservatism, that is, you are talking about, if I'm not mistaken, you are talking about prudence. And in a nutshell, generally the accounting treatments are moving towards fair value. So the prudence is not the primary concern, but whenever there are one of the two choices, if the fair value is not very clearly determinable, then we go for prudence. And in some of the things we have actually applied prudence, but this is the main issue in the framework, and we have addressed it in the framework, not in FAS 1. This is a comment. FAS 1 is modern than other standard versions. The comment, yes. Generally speaking, yes, because most of the new requirements in our new phases, as well as new IFRS and other general reporting requirements, including regulators, etc., whatever was we were able to collect, we were able to collect and comprehend, we incorporated in this one.
Brother Umar, Brother Ashraf Kazan tried to explain his point on the urea 90% account in the comment, although it's in the comment, we can't move it.
But brother Ashraf Qadda, your comment is again in the chat window. I'm requesting to be in the window. But again, brother, thanks, Brother Rizwan, because he's keeping an eye on that. Okay, so for example, if URIA account is 100K, only 90K share in profit and losses, while the 10K does not share in profit and losses. For example, in Jordan, 90% of every balance shares in profit, while the 10% does not share. Our FAS 27 and earlier FAS 6 and 7 had this issue addressed, because at times it is a part of a contractual arrangement. So Brother Ashraf, if it is a part of a contractual arrangement, then because the reason, let me tell you the reason as well. There is no harm in having it, because at time there is a requirement of the central bank to keep the cash equalization, the cash reserve requirement and the statutory liquidity requirement, CRR and SLR. In different countries they call it different, but normal term is CRR and SLR. So if the CRR and SLR is there, normally it is allowed by the banks, like allowed by the Sharia board, that they can put that 10% into that CRR and SLR, which is not generating any return. This is option one. Option two is, it's the bank's contract with the customer saying that we will be putting 90% there and 10% we'll keeping as a liquidity reserve ourselves. Means that this is not a liquidity reserve that we are putting in the bank, rather we are going to put this liquidity reserve with ourselves. So in that situation, brother, in both the situations, it will depend on the contract of the bank with the customer. So what the contract is saying, if the contract is saying that 10% will be considered qard, then it will be recorded as a liability, because it's not risk sharing, uh, and 90% will be recorded as a quasi equity. If they are just saying that it is still part of the mudarba contract, but only being on a safe side, the mudarba is keeping 10% as a reserve. So these are two different situations. One situation is, I say in the contract that 90% is mudarba and 10% is qard. The second option is, we say that 100% is mudarba, but the mudarba manager, the mudarib, is keeping 10% as a reserve, so that 10% will not generate revenue. So these are two different contracts. In the first contract, 10% goes to liability, 90% goes to quasi equity. In the second contract, 100% goes to quasi equity.
There's a hand raised, Brother Umar, from Mutawakkil Hudu.
If you can allow, we can take a question, or you want them to write the question, as you like.
If he wants to answer, Mr. Mutawakkil, if you would like to ask a question by voice, you're allowed now. I guess we can continue.
Okay.
Assalamu alaikum.
Wa alaikum assalam.
Yeah, my name is Mutawakkil from Ghana.
Please,
Welcome,
yeah, we
brother.
can hear you, brother. Please go ahead. We can hear you, brother.
The question I asked earlier about the IFRS. I asked a question about IFRS 15, the steps. So after recognizing the revenue and the time period, we are expecting the actual cash to come, and it's not coming. Does that mean that you have to impair the revenue as per the IFRS 16?
Okay.
I wanted
it is contractually, brother Mutakal, it is contractually deferred, or it is just delayed.
It's delaying. And the
we have FAS 30, brother. We have issued FAS 30. FAS 30 addresses the impairment, credit losses, and onerous commitments, and it is very much aligned with the IFRS 9 requirements with regard to the credit losses. So if it has gone to, it has delayed, so it will be going to a stage, like it will be changing stages as per FAS 30, and according to the respective stage, there will be an impairment loss allowance.
Perfect. I think I get it now. Okay. So it has to go through the processes of the IFRS 9, right? The stages.
Yeah, it's close to IFRS 9. FAS 30, our FAS 30 is close to IFRS 9. Not exactly as IFRS 9, but close to IFRS 9.
Okay. All right.
Yeah, thank you, brother. Okay. So then these are the general disclosures that we were discussing about related party. Then we have going concern, corresponding figures. Then we have the next section. Now, if you see, this section is presentation and disclosure requirements in primary statements applicable to all institutions. Okay. So this is that financial statement should faithfully present the financial position, etc. Then we talk about what are the main contents of the statement of financial position. That is the balance sheet. So these are the main contents of the balance sheet, and these generally apply to all type of institutions. A specific standard on takaful or on Islamic investment schemes, etc., can override this one. But otherwise, in absence of any such standard, these requirements are applicable on all of the standards. So these are the general requirements of the statement of financial position, that is the balance sheet. Then we have what are the main disclosures, main requirements. We have mentioned them all. What are the main type of instruments? And these are the suggested minimum contents which are to be there. Again, as I mentioned, we cannot go paragraph by paragraph, but we are willing to take comments paragraph by paragraph if you have. Then movement in the impairment account, impairment and credit losses, that disclosure requirement is here. Then there are disclosures for the either on the face or on the notes on the different type of liabilities. It can be on the face or in the notes. And then we have the equity related disclosures. Then we come to statement of income and other comprehensive income. It may be one statement or two different statements, as we discussed earlier. One thing is very clear, that we have classified the things in the balance sheet and in the income statement according to the nature of the transactions, like trade based modes, and then ijara based modes, and participatory investments, and investments in shares and other securities. So these are the general classification that we will be having on the balance sheet, and similar classifications then we will be putting on the income statement. So normally the approach will be that what are appearing on the income balance sheet, we'll be taking income from them on a similar manner, and we will club them together in a similar manner. Then provisions and losses for respect of trade-based modes, etc. Income and gain from investments, etc. Income from off-balance sheet assets under management, from associates, others, etc. So these are then we have the general admin expenses. Then towards the end, we have taxes and zakah and net income and loss. If you see, as I mentioned, that this one is combined, means that income that is coming for the with what is coming from the mudarib accounts and from the owner's own investments, they are all put in together in this income statement. Our earlier income statement was asking them separately. This income statement is asking them together. The difference is, as I mentioned, that income statement now becomes more closer to IFRS and other reporting requirements, and it becomes much more presentable. And the requirements of disclosure for the quasi equity are put in a separate statement, which will be attached immediately after this one.
Brother Umar, we have two questions.
Okay, let me take the questions now. I think three now.
Yes, two from Mufti Khaja.
Okay, so we have any major changes in legal disclosure requirements for zakah obligation? The quick answer is zakah obligation will be of multiple types. In some situation, it will be a legal obligation. In some situation, it will not be a legal obligation. So there are three types. So actually, we have issued the exposure draft on zakah recently, and these three types, that what is the legal requirement of the country jurisdiction, what is the requirement as per the statute of the entity, and what is the requirement as per contractual, etc. So there are three types. Those three types will have different reflection in the financial statement. Like if it is a legal requirement, like in Saudi Arabia or Kuwait, if it is a legal requirement, then it will come into the income statement. But in other situations, it may be either in the statement of change in equity, or just as a disclosure. So these things are the situations that we are actually putting in the zakah standard. So there are additional disclosure requirements with regard to zakah base, etc. as well. So that is actually covered in that standard, not in FAS 1. Brother Khwaja Nurulsan has a point, section 115B, sukuk as per underlying structure or what? And same as under 20 for securities income gain perspective. So let me, so you have comment on 115B and 120. Let me go to those points. Brother, here sukuk liability type only will come. Brother Khwaja, we had issued a sukuk standard FAS 29 exposure draft. The standard is finalized on part of board, but it is pending finalization of the Sharia standard on sukuk, after which it will be realigned. That is standard number 29, which was issued as exposure draft, and the exposure draft is still available on the website of AAOIFI. That standard actually defines the sukuk to be according to the according to classification, not according to the underlying structure. Means classification is based on the underlying structure, but because otherwise you can have 10 different types of sukuk or 25 different types of sukuk. But from our perspective, we said that sukuk can be equity type, it can be quasi equity type, it can be liability type. Within liability type, it can be either a financial liability or a non-financial liability. Like for example, delivery of salam asset would be a non-financial liability. So there are 4 categories which are there in that standard. Further details you can find in there, because different type of structures, we have defined principles according to which different type of structures can be classified within these 4 categories. So we believe that the 4 categories will remain the same, even if you can have 10 different types or 25 different types of sukuk, they all will have to be classified according to those 4 types. So sukuk liability type will come in here. Sukuk equity type will be the ones that go to the tier 1 or and they will be a part of the equity, and quasi equity type will go into the liability. So there are different categories that are defined in FAS 29 are just put in here. With regard to 120B,
120A, sir.
120A. Income and gain from trade-based modes, Ijara and others. It will be again on the face of the income statement. It will be only a summary, the net figure, the total figure. But in the notes, they all will be explained according to the nature. Do we have any other question? Okay, let me move ahead. So we were at statement of change, statement of income. Then we have statement of other comprehensive income, non-controlling interest related part to be identified, and basic and diluted EPS to be defined. Again, we believe that EPS standard from IFRS is good enough. We don't need to have a separate EPS standard, but we just put in a requirement here that EPS need to be disclosed. So further details can be referred to relevant IFRS. A statement of changes in owner's equity, the period covered and all these requirements, all the movement there has to be disclosed.
There again, there's a question related to zakah. Shall I read it out?
No, let me see it. Okay. Is the legal and voluntary distinction for zakah obligation provided so as to take into consideration to varied requirements situation across jurisdictions? Like some countries, making it compulsory and some optional in terms of flexibility and align the local accounting requirement. A very good comment, but I would say that you need to attend our public hearing. Inshallah, upcoming public hearing will be on Zakat standard. So you need to attend that one, inshallah. Sister Farida and Marjan, it would suggest that if you can invite the participant to the public hearing, make sure that you invite to the public hearing for zakah, because these issues will be addressed there. The quick answer is yes, but in order to see how it works, actually you need to see that standard. The exposure draft is now available on our website, so you can even have a look at it now. Okay, then we have a statement of cash flows. Again, cash flows statement, we don't have a separate standard on that. So we put in minimum requirements and we leave remaining to generally accepted accounting principles. Statement of changes in off-balance sheet assets under management. This is specific to AOIFI. As our brother asked initially about the RIA accounts, restricted investment accounts, RIA accounts and off-balance sheet wakala and any other similar type of instruments will be appearing here. And they will be presented in this statement with the opening balance and the movement. And these are the these are the disclosure requirements which are related to these off-balance sheet assets under management. So it includes the movement, income generated, nature of assets and details of assets, any investment units and their movement, etc. And the notes with regard to this statement should provide the nature and the rights and obligation, etc. So this part was applicable on all type of Islamic financial institutions. This part 2 is applicable on Islamic banks and similar IFIs. And these are the specific requirements. So whatever is there in part 1 that we have seen, it will be applicable, but then there are additional specific requirements. Like for example, in the statement of financial position, you must have to disclose the cash and balances with central bank, treasury receivable from participatory investments with financial institutions, and separate disclosure of assets jointly financed by institution and as quasi-equity holders, and those exclusively financed by the institution should be there. The movement and allowance for impairment and credit losses should be there, and it should also be segregated between the quasi-equity and owner's equity. So these are the very specific requirements which are applicable on the banks only, the banks and similar institution only. Also, we are talking about tier 1 equity and tier 2 equity, which is more applicable on the banks because of the capital requirements, and the instruments are normally, those instruments have been issued normally by banks only. Then we, in the income statement, we have these requirements to be disclosed with regard to the type of instrument like mudarba, wakala. You need to distinguish and you need to identify the methods used to allocate investment profits and losses. So there are specific disclosure requirements with regard to quasi-equity, etc. Then the reserves related requirements, including the movement here. So this is a response partially to the question we had earlier. That is a partial response, as I'm saying, because the detailed disclosure requirements are there in the FAS 35. Then there are quasi-equity shares and all that. So this is a statement of income and attribution related to quasi-equity. Most of the things related to this one are applicable to banks. So here all the detailed disclosures are required. The banks have more significant disclosure requirements with regard to capital and others. So the risk management disclosures regarding to banks are particularly related to capital management, etc., have been inserted here, and including the nature of risk, etc., and the disclosures related to that, concentration of asset risk and their disclosures, classification of quasi-equity and other investment account holders, allocation of profits to them. So these are the specific requirements applicable to banks and similar financial institutions. Then this is part 3, which is related to authoritative status of the conceptual framework, etc. The revised conceptual framework is an integral part of AOIFI FASs. Why we are putting it very clearly, because I have talked about this thing earlier as well, that this is very important issue. That at times we have seen that some of the institutions were ignoring earlier framework, while the new framework is even more clarified and more elaborative with regard to particularly the Sharia requirements on accounting. These are included as a complete chapter there. So it's very important to have regard of AOFI framework, conceptual framework of financial reporting, before we go ahead. Sister Farida, please note it down. The revised conceptual framework, the name of the framework need to be updated here. Full name, the revised conceptual framework of financial reporting for AOFI. So the full name has to be here. Noted?
Yes, brother, it's noted.
Okay. Okay, now this is a very important hierarchy that we have put in. This is there in the standard, in the framework as well, but we have reproduced it here because it's very important. So whenever you develop accounting policy, you need to follow number one, AOFI FAS, which is specifically addressing the respective transaction, event or condition. Number two, FAS on similar matter. So if you don't have a FAS on this one, but you have a FAS on similar matter, you need to apply that FAS on similar matter. Number three, even IFRS has a hierarchy like this, but their hierarchy is slightly different from ours. Then you have to follow generally accepted accounting principles as applicable in the respective jurisdiction, insofar as these are not against the conceptual framework and Sharia principles and rules. So this is the condition that you can refer to IFRS in absence of AOFI FAS or AOFI FAS on similar matter. You can refer to IFRS or other generally accepted accounting principles, but you must show, insofar as these are not against the conceptual framework and Sharia principles and rules. So the liberty of referring to IFRS is now subject to compliance with the conceptual framework. Even the old standard, I can mention that even the old framework and old framework, not the Sharia, not the accounting standard number one, but the old framework had mentioned this thing. But there was one issue with regard to the authoritative status of the framework. So this, by virtue of, at times what happens that, for example, there is one country that adopts AOFI financial accounting standards. Now, there was a question by some of them that, okay, we adopted financial accounting standards, but framework is not a financial accounting standard. Framework is a framework. So framework, it does not become part of the legal system in some of the countries because of this loophole. So that's why we clarified it very clearly in the standard, and by putting it here, that the revised conceptual framework of financial reporting by AOFI conceptual framework for financial reporting. And sister, you need to mention this very clearly, the full name, to make sure, because the authoritative status part must mention the full name of the framework.
Yes.
So the purpose was, if you can understand, the purpose was that we do not want that loophole in the system where the conceptual framework is not considered a FAS, and hence not considered a FAS means that it is not to be followed. And in absence of our AOFI FAS, people used to directly refer to IFRS and apply some of the accounting treatments which in our view were not compliant with Sharia principles and rules. So we have made it a very clear condition that number one, the revised conceptual framework of financial reporting by AOFI is an integral part of the AOFI phases, and all AOFI phases shall be understood and interpreted in the context of revised conceptual framework, number one. Number two, the hierarchy clarifies that generally accepted accounting principles, for example, IFRS, are applicable insofar as they are not against conceptual framework. So this is, and the Sharia principles and rules. So this is a very important issue that we have tried to address here, because otherwise from the legal standpoint, there were some weaknesses. The management judgment, as long as it is in line with conceptual framework and Sharia principles and rules. So even if IFRS is silent on that issue, or there is no specific IFRS or any other generally accepted accounting principle, you can apply the management judgment for that, but still that judgment has to remain in line with the conceptual framework and Sharia principles and rules. So this has an important insertion in our new one. The effective date will be 1st January 2023. We plan to finalize this standard. There will be few more public hearings on this one before we finalize it. And there are some other simultaneous projects going on, which we will try to complete at the same time. But in a nutshell, we would still be allowing a bit of time, means that we try to, and we intend to finalize this standard within 2023. But we hope that like, you know, other incidental projects are also finalized. With this one, the second revised exposure draft of this standard includes some very important amendments to other standards and consequential amendments to which are there. So the first one is that we will, for sure, it will withdraw standard number one, earlier standard number one, and it will be the new standard number one. Then it will withdraw foreign currency transactions and foreign operations. However, the provisions related to foreign operations are safe till the time these are covered by a new standard. That is, the consolidation standard may be revised, which will cover that aspect. But other than that, FAS 16 will be withdrawn. FAS 1 withdraws the FAS 26, investment in real estate, because investment in real estate does not have a it does not have a very again we would say that it does not have a very significant value addition, and since the income the fair value gains were going to the equity, that is against IFRS and that is against our new framework, so actually it has to be withdrawn. uh, Maybe we will not come up with a replacement standard because the main core principles in IS 41 are good enough. FAS 1 withdraws FAS 22 segment reporting because segment reporting minimum requirements are included here, and detailed requirements as contained in IFRS we believe are have no Sharia issue, so it's no point in having a duplicate standard and creating confusion in the market. This one has adopted certain terminologies that are different from the terminologies prescribed in respective AAOIFI phases for better understanding the nature of the transaction and to standardize their use. The board discussed the matter of terminologies at length and observed that various projects are currently underway to revise and update the existing phases. The standardized terminology shall be introduced in the new AAOIFI phases. However, till the time AAOIFI phases are revised, the standardized terminologies adopted in phase 1 shall supersede the terminologies used in respective AAOIFI phases. Uh, Sister Farida and Marjan noted down that this paragraph needs amendment because it appears like a basis of conclusion while it's a part of amendments. So the board discussed part will be deleted.
Okay.
Okay.
Yes, yes.
Okay. Now these are additional, like the terminologies which are there. Like earlier term was Muraba financing, Mudarba capital, Mudarba financing, Mudarba capital, Mudarba financing capital, non-monetary Mudarba asset. All of them will become Mudarba investment. But again, phase 3 and phase 4 are under revision. So this will be inserted once it is done. But right now, this standard terminology list has been provided to streamline for the time being the requirements of the existing standards with this one. So this is actually for the time being, and it is not like a permanent solution because these standards are generally under revision. Then there are the definition of control. For the time being, there is a difference between FAS 23 and FAS 1 definition of control. So the definition of new FAS 1 control definition will supersede the definition in FAS 23. However, we have already commenced the project of revision of FAS 23. And in the impairment and credit losses, fair value through equity, our earlier standard, since we did not have a other comprehensive income thing, so there are a lot of amendments which are related to fair value through other comprehensive income. So we are going to insert a lot of these requirements in different sections of in different standards according to the new terminology. Then we have in the amendments in FAS 33. Actually, the maximum number of amendments are in FAS 33 because FAS 33 is actually handling the investment in Sukuk shares and similar instruments. So there are a lot of fair value through equity treatments which are already contained in FAS 33, which will be amended by this standard, and they will be fair value through income statement. And it addresses one of the questions that we received from our brother with regard to Qatar Central Bank, because Qatar Central Bank and some other regulators have these issues, and there was issue of recyclable differences and non-recyclable differences. Through these amendments, we are trying to resolve most of these issues. So I'm not taking you through all of them, but in FAS 33 particularly, there are more amendments, if you can see.
Brother Umar, there are a couple of questions if you would like to take.
Now I will take the questions in the end because we are completing the time. So let me complete the presentation. Then we'll take all the questions because time is towards the end. So a presentation is also ending. So mainly if you can see that these amendments are all related to, particularly in FAS 33, these are all related to the other comprehensive income versus equity concept. So we have been keeping it there. Basis of conclusion, we don't need to discuss it unless we have a comment, we can take those comments. But otherwise, generally speaking, our presentation is done. If the time permitted, we would have shown you the illustrative financial statements as well. We will be shortly issuing maybe exposure draft of that as well. We have not yet decided because that are going to be issued as a technical release. Maybe we will be holding a shorter public hearing. Shorter means limited parchments public hearing, or I would say that a round table on that. But with that, let's quickly go through the questions which are there. So if we take the questions first from question answer, are there any in the chat window? Okay, we have brother Isam Telmisani. Thank you, brother, for joining, and thanks for your kind comment, brother Isam. Thank you very much. In that case, we will have a lack of standardization between countries. Now, which point it is actually addressing, brother Isam? I'm not very clear on this one. So if you can add clarification to your question in the meanwhile, we'll take it after this. We have whether the items of cash flow statement of an AAOIFI should be divided into three categories. Yeah, exactly. Yes, the issue is yes, it will be done as per IFRS, and actually the minimum requirement is mentioned in our standard, and we are going to put the illustratives as well. But there is one issue which is with regard to the quasi equity and some other items, that whether they are operating activity or financing activity. IFRS has also not put a very hard and fast rule, and they said that you can define these things according to your nature of activity. So maybe according to the nature according to the nature of activity, we'll keep an option open. So we did not provide any hard and fast rules, but the three categories of operating, investing, and financing activities will remain the same. And I think we have mentioned it in the standard. Just note it down, Sister Farida. If it is not mentioned already in the standard, then we need to do it. Then we have another comment, which mechanics of corporate governance and corporate Sharia shall be implemented in IFIs by the world, so it can be a good performance for these institutions. Thank you. In a nutshell, AOFI is trying its level best to develop a comprehensive set of governance standards, including corporate governance and Sharia governance. And we are more recently working with IFSB, Islamic Financial Services Board, as well, to develop a comprehensive joint project which is on Sharia governance framework for Islamic financial institutions. We hope that the joint project and the result of the joint project and the new joint standard that we will be issuing will be a very good basis. And in addition to that, it will supersede some of our existing standards, but our remaining standards are still there. So we are trying our level best to provide a good solution. Brother Isam, can you further clarify your point with regard to what aspect you were talking about, lack of standardization between countries?
Brother Umar, in the meantime, there's a question on personal, the question that has been come to me personally on the effective date. Now we have issued the conceptual framework for the new revised conceptual framework, and the FAS 1 will only come into effect in 2023. The question is so what should we refer to in the meantime?
Old FAS 1 is already there. Old FAS 1 is already there. It will continue to be applied as soon as this one is in exposure draft stage. As soon as it is finalized, people can decide to like adopt it early as well. So it will. But again, 2021 already started. Even if we are able to finalize it within 2021, because there will be more public hearings and there will be more meetings to finalize this one. So even if we are able to finalize it within 2021, it means that you will still be like having only 1 year to prepare for it, and there might be some new disclosure requirements for some of the banks. It is not very easy to immediately apply it. So I think it is a reasonable time that exposure draft is there, and the banks can prepare themselves for the new standard now. And once the standard is finalized, they will have nearly 1 year to implement. Brother Sam, now I can see you have a point about the your point that one country follows AOFI standard, another will follow the framework only. In that case, what a lack of standardization. Brother Sam, thank you very much for this point. There will be no. We are talking about those countries which follow AOFI. But when they follow AOFI, for example, I gave this example earlier, and let me repeat that example. That till 1 year back, we did not have a wakala standard. So what was happening, brother? That the banks were following IFRS 9 for wakala. They were considering a wakala to be a liability under IFRS 9 rather than considering its true nature according to Sharia and its true characterization for the accounting purposes. Now, when we developed the standard, the accounting treatment completely changed. But in between, before we finalized the standard, there was a query received from a large financial institution, Islamic financial institution, and we responded to them according to framework that this is the treatment for wakala, and that treatment is more or less the same as was finalized later as a standard. So in a nutshell, what I want to say is that it's not about that some countries follow only a framework. We are talking about a country following AOFI standard. And in case of a new transaction or the old transaction, but still not addressed by AOFI, they at time refer to IFRS. We are saying that you can refer to IFRS, like we mentioned at a lot of places, cash flows, segment reporting, property, plant and equipment, related party, all these disclosures, all these things you can refer to earning per share, you can refer these all to IFRS. But where there is a transaction of Islamic finance involved, there might be some characterization issues. And in that situation, we believe that you first refer to the AOP framework and you refer to the Sharia principles and rules before you refer to IFRS. So IFRS treatment will be okay only if it is in line with the accounting treatment of AOP. So that is our view. So this is actually not going to create more differences. Rather, it is going to streamline the differences and harmonize the practices. Do we have any other question unaddressed? Okay, we have from Sister Fatma from Algeria. Some conventional banks have recently opened Islamic window. We request financial statement or regulatory financial statements with schedules detailing Islamic finance products. Sister, our standard number 18, FAS 18 says, we are revising that standard, but even the old standard says that for a window, they should be following the AOFI accounting standards. They should be following the accounting policies in line with the AOFI standards and disclosures in line with the AOFI standards, and a set of financial statement related to that window that is prepared in line with AOFI standards should be attached to the conventional set. So this is the treatment that we suggest, and we are improving our standard number 18, which will be providing better guidance, inshallah, going forward. But even as of now, the old FAS 18 is there, and according to that, these windows should be developing. So I would suggest that the central bank should be requesting them to develop their window financial statements according to AOFI, and these window financial statements shall be attached to the conventional bank's financial statement as a segment. We are talking about AOFI is doing with the IDC to develop Islamic finance framework. What are the specific timelines for it? Thank you very much. This is a good project that has been initiated by the IDC. 2 years back, 1.5 years back, we signed an MOU with them to support them. And there is a steering committee of the project in which there are different standard setting bodies and infrastructure institutions represented. AOFI is a part of that one. And it is moving with I believe it's moving with a good pace, but there are a few things to be clarified with regard to the scope and outline. Once this is sorted out, I think it will run on a very fast pace, inshallah. So I think all the questions are addressed, and we have completed the time. We are 4 minutes above time. So actually,
there's one comment again. The tab summarizing the amendments of different phases are not attached to the draft that was sent.
can you explain, brother? Again, can you mention again? I couldn't.
So I think they're asking about the table with the amendments, but that is part of our exposure draft. I think we just need to clarify.
There are two exposure drafts. There was one exposure draft issued more than 1 year back. It was in 2019. Then there was a revised exposure draft which was issued in 2020. So actually, normally we don't do it. Normally we finalize after one exposure draft, but FAS 1 is a huge project. and it was already continuing for more than 2 years. So when we completed the first exposure draft and we issued it, we realized that there are we knew that consequential amendments are there, and we kept a place for that, but we knew that there are more issues to that. So we actually decided to issue a revised exposure draft of FAS 1, after which incorporating these things and rearranging into 3 sections, that part A and B and part 1 and 2 and 3, the 3 sections that are rearranged. The main contents remain the same, but these are rearranged. So the new exposure draft contains these consequential amendments. So maybe you have you have accessed the old exposure draft. So maybe you need to access the new exposure draft. Or if you are unable to find it, please drop an email to accounting@aoifi.com, or Sister Farida provided her email address on the chat window, so you can provide to her, and she will provide to you. If you provide your email to her, she will provide. So with that, I think we are already 5 minutes above the time. If the time had permitted, we would have gone through quickly the illustratives as well. But I think for now we cannot go for that. Let's try to conclude this one. So with that, Brother Rizwan, would you like to conclude? I would like to thank everybody. Back to you, Brother Rizwan.
Thank you very much, Brother Umar, for a very comprehensive overview of the standard. So first of all, thank you to you, and of course, thank you to everyone joining us, all the participants, the regulators, the financial institutions, the academic institutions joining us from different parts of the world. Thank you for sparing your time and being with us, and keeping this an engaged kind of session for the collective good of the industry. If still you have some comments and feedback on the exposure draft, please do share on accounting@aoifi.com. And additionally, I would like to thank our partners for this public hearing, the Bahrain Association of Banks, as well as the Central Bank of Bahrain, who has extended their generous support to ensure that the message reached out to as many stakeholders as possible. Of course, there will be further public hearings, as we usually do. There are more than one public hearing on a particular standard, so we plan to organize at least 4 public hearings on FAS 1. As it's a comprehensive standard, and to ensure that all comments are incorporated. So if you wish to attend future events, please drop us a line, and of course the information will be shared on different platforms. And if you do have any feedback, post this session, so please drop us a line again. Your feedback is very important. So this is it's about making sure that the final output that we have is comprehensive. So please. And of course, there will be other public hearing on other standards, both on the financial accounting standards on the FAS side, as well as on the governance and ethics side, and on the Sharia standards. So we'll keep you informed. We'll do our best to have you involved in as many events and initiatives possible, inshallah. But if you would like to get involved in the work that AAOIFI is doing in general, something you would like to have more information about, or you would like to clarify certain things on the standard itself, please do let us know. Reach out to us. You can drop me personally at rmalik@aoifi.com an email, or if you would like to reach out to or find out more information on our capacity building programs, reach out to us. Our emails are all there. We are here to serve you, inshallah, and together we can ensure that the industry moves forward. And it cannot happen just by one particular party. It cannot have happened by the regulators. It cannot have happened just by the individuals. All of us have to come together to ensure that we work hand in hand for the collective good of the industry. So with that, thank you very much. Thank you for the AAOIFI Secretariat, as well as the team at Central Bank of Bahrain and Bahrain Association of Banks, in particular Sister Abir and Brother Adnan for the support. And inshallah, we look forward to having you in the future public hearings and other events that AAOIFI organizes. So with that, stay well and stay safe, inshallah. Looking forward to having you, inshallah, in future events. Assalamu alaikum wa rahmatullahi wa barakatuh.
Assalamu alaikum. Assalamu alaikum.